We are joined here today by Mark, co-founder, CEO of CoinFLEX, a spot and derivatives crypto exchange. Thanks very much, Mark, for joining.
Absolutely, yeah, great to be here. Thanks so much for having me.
Cool. Yeah, I think last time, for those that probably don't remember, but can see in our archive, the last time you came around was about 4 years ago, and that was in conjunction with CoinFloor, a UK-based fiat spot Bitcoin exchange. And now you're here to discuss a sort of like spin-off, I guess, project, CoinFLEX, which started in 2018. Maybe you could just spend a bit of time giving, because a lot of people that are listening might not know what CoinFLEX is or even what CoinFloor is. So maybe you could just sort of start out by introducing yourself and what CoinFLEX is bringing to the table.
Yeah, absolutely. So I got into crypto back in 2012, just buying Bitcoin and reselling them, and then kind of found the need. There was a need for a UK Bitcoin exchange, so I started CoinFloor, which became the first and largest Bitcoin exchange in the UK. Ran that for many years and dealt with all sorts of the wonderful troubles of a spot fiat exchange around banking and all sorts of things, and found that derivatives were a much more interesting space. We were a profitable exchange, CoinFloor, but saw there to be much more opportunity in derivatives, and so we shifted focus, moved out to Hong Kong, and started CoinFLEX, which was and is the first physically delivered futures exchange. Nowadays, we're very, very focused on kind of passive capital products. So we've realized that there's a lot of yield sources in crypto derivatives, around basis and around just volume, and we can tokenize a lot of these products and create sources of yield for people. So we've got FlexUSD being one and the AMM being the other, and I think we'll get into a whole bunch of these things. So
yeah, we'll definitely do a deeper dive into those things, but just so that people have a sort of higher level understanding of what they can do at CoinFLEX. You don't support fiat transfers, right? Like if I have euro or USD, so not USD coin or USDT, but if I have like normal fiat, I cannot interact with CoinFLEX. Is that correct?
Yeah, correct. We're not doing that right now.
Cool. So you're offering a I would call it a pretty unique derivatives offering, because most of the exchanges out there, if they're offering trading for futures and such, they're purely cash settled, meaning that if you are, let's say that it's a USDT futures, which Binance offers, then everything, you're forced to use USDT as your collateral, and the PNL is all based in USDT. But in your market, you have, for every pair that you're listing, you have a spot market, so you can deposit the actual currency, or you deposit USDC, which is the main home currency of the exchange, right? Which you just interchange that with USD, like FTX and other exchanges do. And then you have this repo market, which connects the spot market and the deliverable perpetuals market together. Can you explain to people, because this is totally new for, I think, most people trading here, they just sort of ape into some kind of cash settled contract. Maybe it's a fixed maturity futures, or usually it's a perpetual contract. Can you explain to people what is the relationship between the spot market you have, deliverable market, and repo, and what is the implications for somebody that just wants to sort of take a punt on Bitcoin dollar, at 5 times leverage or whatever else?
Yeah, absolutely. So for someone who just wants to take a punt on BTC USD and just trade perps, you can actually trade it very similar to the way you'd trade the original BitMEX perps or the Binance perps or the FTX perps. So you can just put in USDC or Bitcoin or anything as margin, which is a big advantage over Binance and a lot of the exchanges where they're relatively limited. Either you can only put in coin or you can only put in Tether. You can use any number of collaterals on CoinFLEX, but you can put in this collateral, buy contracts, and if the market goes up and you're long a perp, if Bitcoin goes up, then you just get the P&L from those contracts realized in real time. So in many ways, it's very similar for the average punter, but there's a key advantage with deliverable perps in that it makes the basis trade very simple, and we've actually tokenized and we've made it so simple that we've tokenized the basis trade. So what I mean by the basis trade, and then what I mean by tokenizing it is, basically, if someone buys spot, sells a deliverable perp, and then takes delivery, i.e., delivers the Bitcoin and takes receipt of the dollars, the funding windows are every hour, and the deliverable windows are every hour, and so that deliverable, that the source of the delivery of those coins actually comes from what we call a repo market. And a repo market, for people who are familiar with spread markets, is a spread market between spot and perps. So if you buy repo, you're buying Bitcoin and you're also selling perps simultaneously. And if you sell repo, you're doing the opposite. And effectively, it's a lending market. So effectively, it's a way to lend dollars or lend coins, or borrow dollars or borrow coins. And the interesting thing about this is, trading repo itself is complicated. We're not thinking lots of people are going to do it. You have to be a little bit of a galaxy brain, but we've tokenized this into a mintable stablecoin that you can just deposit USDC, mint FlexUSD. We call it FlexUSD, and then you get paid interest every 8 hours, and it comes directly from the perp funding itself. So the nice thing about this stablecoin is it's an only up coin. You only earn positive interest. You're doing the perp funding trade, and because it's coming from repo, you can mint any amount of it and redeem any amount of it at any time, and there's no slippage on that basis trade. So the end result for the punter, again, bringing it all back to the guy who's just going long perps, is that because FlexUSD is such an easily mintable coin, and FlexUSD caps and compresses the perp funding rates, you'll pay less in perp funding on it generally than on CoinFLEX than you would on any other derivatives exchange.
All right, let's talk a bit more about that. I think that's a good high level explanation. So normally, just to sort of play that back in different words for people listening and to yourself, like normally if somebody is trading on, say, BitMEX or FTX, then the funding rate is a function of the price in the order book that's trading over the course of an hour or 8 hours versus an underlying spot index. However, on CoinFLEX, it's not actually deriving the funding rate in the same manner. There's actually a separate market which is determining what this fund rate is going to be, and this is in the repo market itself, correct? So how is this? So if you're not using an index, how exactly are you determining, like, what is the fair funding rate on the perpetuals? Because on your perpetuals, because normally it's a pretty healthy positive rate that people are doing for the basis trade, but more recently the futures curve has pretty much collapsed, and you'll sometimes even see that you'll get paid to go long, so you're not actually making money on the basis trade if you're trying to do the basis trade. So how does this work on your market in determining the funding rate, and then how in this FlexUSD, which is trying to capture the basis, how is it? You said it's up only. How is it handling a market environment where it's actually you're getting paid to long, so you can't actually do the trade to capture any kind of positive funding on that side?
Yeah, so these are great questions. So, if you just thought about the idea of a basis coin where it's buying spot and selling perps, the first thought you'd have is, wow, that sounds like a lot of fees because buying spot has spot trading fees, selling perps has perp fees, um, and you have what's called legging risk. So you have the risk that you buy spot and then you sell the perp. Our repo order book is a market for doing the buy spot sell perp trade in one trade. So if you buy repo, if you go into this order book, you'll notice a few things that are different from other order books. It's priced in percentages, not dollars. So rather than BTC USD, which is priced in dollars, repo is priced in percentages. And what you're bidding for effectively is winning auctions. Now, repo trades 24/7. There are a lot of trades that happen outside of the auctions, but the auctions are basically what sources deliveries. So I don't want to spend all the time on how our delivery mechanism works, but when I want to short Bitcoin and deliver, let's say the perps are trading at a big premium because everyone's going long, and I'm just a spot arbitrager. I buy spot somewhere else, I sell CoinFLEX's perps, and I deliver. If I'm going to deliver, I need to get sourced. I need to have a source of dollars, someone who's basically willing to um, give me their dollars and take over my short position, right? And so what happens is we auction off your interest, which is to get dollars and pass on a short position into the repo market, and someone who's buying that short position takes over, and they give you their dollars, and they end up with a short position and some Bitcoin, which you've delivered to them. So that's how everything adds up, and that's also the cause of funding. So the rate at which that dollar replacement lender, that bidder in the repo order book, has charged, the rate at which that auction has cleared, that becomes the perp funding rate. And so really it's up to liquidity providers in the repo book to basically set the perp rates. And the biggest liquidity provider in the repo book, it's not CoinFLEX, it's not someone external, it's FlexUSD. So it is our stablecoin providing USDC in that repo book that basically sets perp rates. And it sets them in a very similar way to how Compound or any other interest rate platform sets rates. So the more demand there is, the higher the rates will go, and the more supply there is, the lower the rates will be. So it's just takes how much dollars are available in the pool of FlexUSD minted, and then it just also takes how many auctions are happening and how much OI is getting delivered, and it forms a pricing curve very similar to a Compound or an Aave.
Right. So that's leading me into what you mentioned before about FlexUSD being up only. Is FlexUSD's algorithm, or for lack of a better word, is this sort of making sure that there's no negative funding rate so that it's not ending up like losing on the carry, or how is this different
Yeah,
from other markets?
so the cool thing about other markets is FlexUSD is basically buying repo and then delivering. So because it's buying, so when you deliver, you either get dollars, or if there's a delivery failure, you get paid interest. But you can never pay interest if you're delivering. So FlexUSD is never actually just passively like letting the market determine the perp rates. It's always making sure that it's either going to get straight back into dollars or get funding at the max rate possible, which is 3 bips an hour, so a very high annualized rate. So FlexUSD, by constantly delivering, FlexUSD ensures that it never ends up paying any perp funding.
And does that mean that if people are, so I haven't looked at the historical data on the perps, but does that mean that there isn't ever a negative funding rate where longs get paid to be long?
No, we've actually recently had negative funding rates on Ethereum, but negative funding rates do happen on CoinFLEX because what happens is if more people are so I've talked about delivering shorts causing longs to pay funding, but if the prices of for example recently on the ETH perps, if the prices of the ETH perps are so at a premium, then you have a situation where arbitrageurs are delivering long, and if there's enough people delivering long that they outweigh the people delivering short, then the opposite happens and you have longs getting paid to long.
Right, and Flex USD doesn't get into a problem where it's losing money on that because it is just making sure that it's delivering to be flat, or how is it avoiding that?
Yeah, exactly. So if FlexUSD had an ETH position, it was long ETH, short perps, and and that was when ETH was paying, longs were paying, and then once the funding regime switched, FlexUSD delivered its ETH position, and at some point didn't get back into another ETH position because the funding regime switched, and so at that point it was totally out of the ETH market and into other markets.
Right. Okay. So that's how it doesn't get. So because there are other exchanges that have this kind of cash basis arbitrage trading, which is automated, and sometimes you can actually lose a little bit because it's not smart enough to sort of avoid the trade or have a mechanism where it can avoid paying that rate. So
exactly.
I just wanted people to have some background about when you say up only, like we got to make sure they understand how the up only is legit.
It's legit up only.
All right. The other thing that I wanted to highlight, which you pointed out, was the multi-collateral aspect. So on most exchanges still, there actually isn't a multi-collateral function. So on CoinFLEX, the home currency, like I mentioned before, is USDC, which is sort of interchanged and referred to as USD. So you're not actually delivering dollars. You're delivering, like in these kind of contracts, you're delivering USDC. But you could also deposit Tether, you could deposit Bitcoin, Bitcoin Cash, ETH, whatever other assets, and that will be then margined as USDC, which you can then use as collateral to enter positions in however many contracts that you offer. And this is only, at the moment, some of the top exchanges, Bybit, Binance, OKX, you're not able to really trade this way. You kind of have to choose either, like you mentioned before, Coin for inverse contracts or Tether for linear, normal, traditional contracts. It's only really sort of FTX or I know BTSC also does it, but it's still not very popular to do it this way. But it's actually the way traditional markets tend to allow margining, and I think it's a huge benefit. So how do you manage the risk on doing this? So I think the big reason why exchanges don't do this is because there's if you're trading contracts that are USDC quoted, then the P&L is in USDC, which means that if you're holding positions that are in a loss and you're not holding USDC collateral, then this is sort of an imbalance in the system that needs to be reconciled. So on FTX, the way that they manage this is that you pay interest on that because it's considered basically a loan that the user is taking, or they also can force convert if your loss reaches a certain magnitude. So how does CoinFLEX manage this quirk in a multi-collateral margin system?
Well, we realized that in order to, at first we were just doing it with limited balances. And so we were just saying, well, once you go past a certain amount, we're just going to convert you. And then we realized actually that people really liked the ability to fund in BTC or fund in ETH or something. And we realized, well, if in order to solve the asset mismatch of, some guy in Bitcoin who's down a bunch of dollar P&L and some guy who's up dollar P&L, how is that guy able to withdraw? In order to resolve that, we really need like a short-term lending market. Oh wait, we already have this. It's called Repo. And so once we realized that Repo would be the perfect way to resolve this balance, we basically just created a backend system to, on any of these negative dollar positions, anyone who's funding Bitcoin, we'll just repo their assets out. And it actually happens transparently in their account. It's behind the scenes, so it's in a separate tab, so it doesn't get in the way of your aesthetics or your API or your balances. But there is a tab for people that are using Bitcoin or ETH as collateral. There is a tab where you can see your repo borrows that are happening underneath, and so you're actually just borrowing effectively from our repo market, which really means, again, you're borrowing from FlexUSD. So it's great for FlexUSD because the more people that use these other coin collaterals, the more interest that gets paid to FlexUSD, and so it's just good for adoption of that stablecoin.
Right. So instead of auto converting people, which I'm not sure if it's still in your documentation, but I think at some point, if you had a unrealized loss of 10,000 USDC, which was not backed by USDC collateral, then this would you basically auto convert non-USDC assets in the spot market to cover this this loss. That is no longer the case. Instead, people are sort of forced to borrow to cover this in the repo market, and then they're paying an interest rate on on this this loss. Is that accurate to say?
Correct. Yeah, exactly.
And so it doesn't matter how big it is. Like I could have a $500,000 loss. Obviously, I would be collateralized, so maybe I've got 50 Bitcoin in my account or whatever. But this would not I would be able to keep my position open without any auto conversion, and it would just be it would be considered a loan because that's what it really is in the system.
Yeah, exactly. We have people that are doing this with $1 million P&L swings in USD terms, and they're just funding in crypto. And it's really advantageous because, especially for the crypto natives out there, you don't want to convert to USD for anything. But the ability to have USD as the P&L and margin currency is excellent from the perspective of trading lots of coins. So if you want to trade 50 different coins all in one margin account, this is the right way to do it. But if you want to be truly crypto native, maybe you want to be holding mostly spot crypto positions. And also there are times when the value of a dollar is really high elsewhere, and so you don't want to be putting your dollars as margin on CoinFLEX. You want to be putting some lower interest rate or zero interest rate crypto. So yeah.
So how? Just one more point on this, because a lot of people, they're using like BlockFi or other stuff to do over collateralized lending. Would CoinFLEX be a platform where people could sort of deposit a bunch of Bitcoin or ETH or whatever, and they want to just take a USD or USDC loan out? Would this be something they could do within the repo market?
Yeah, you can do that within the repo market, and the advantages are that it's instant. So it's a one-click trade in the repo market. You just buy or sell, depending on what you're trying to do. It's extremely deep, so you can for the markets that are really active in repo, it's millions of dollars deep, less than 1 basis point wide. So you can do $5-10 million without moving the market more than 1 basis point. And so it's a super deep market. You can borrow or lend as much as you want. You can do these kind of over collateralized borrows, and there's like less paperwork and less effort, and also you have better collateral rates and margin rates because you're not a lot of these centralized platforms that aren't connected to futures markets, they actually go off and remargin and do that trade in the futures markets. But we are a futures market directly ourselves, so you get the full margining, the full leverage that you get from futures, and you get the best pricing that you get because a lot of those other platforms are just effectively intermediaries that are second layer connections to futures markets, borrowing synthetically, rather than going directly to the source of these types of borrows. So
exactly, yeah, that's whenever people are lending money to BlockFi or Next or stuff like that, they're like, oh, I can't believe that they're willing to pay these kinds of rates. But like you're mentioning, the source of that yield often behind the scenes is coming from a derivatives market, and you're on CoinFLEX offering this via repo, but also the spreads market where you can sort of capture the difference between the perpetual and the quarter contract, where you can there's a multitude of strategies that can be implemented directly on CoinFLEX without some middleman that is sort of doing the trade and taking a fee from you.
Exactly, and that's really our ethos. With FlexUSD, you're doing basis trading without any middlemen. You can literally we've open sourced the code that does the repo trading, so you can literally see all of the trades. You can see exactly how the algorithm works. And you can participate in the repo market yourself if you think you can compete with FlexUSD. Go ahead, just trade in the repo market. With the spreads, it's the same thing, and with our AMM as well, it's a way for democratizing liquidity so that anyone can access it. So yeah, we're really, a big part of our focus is taking trades that are juicy and interesting and sexy, and making them more accessible to the general public via democratization.
Cool. And so I remember when I was looking at CoinFLEX a couple of years ago, just to shift gears to like the tech. So there's a lot of people here that are doing like algo trading and stuff like that. And if they were looking at CoinFLEX's API maybe like 2 years ago, you guys have been around since 2018, I think you mentioned, right?
Yeah.
And I think back then the REST API was not quite not very user friendly. But now you've got a sort of much improved REST API and a fully functional WebSocket where you can also do order management through the WebSocket. Is that correct?
Yeah, exactly. So we've upgraded all the APIs, and a bulk of the system. So if you saw us back when we launched, the trading interface wasn't very great. We've got a much better trading interface. Yeah, I mean a bunch of things have been upgraded, but the APIs are pretty nice right now. And in fact, we're making a bunch of further improvements to them at the moment as well.
So if somebody wants to get the lowest latency, where you guys sort of, I think you're on AWS, right? Where do if people want to get the lowest ping? Where are they going to be putting their bots?
AWS Tokyo. I'm not sure exactly which zone, but if you want to find out, just ping me at Mark David Lamb on Telegram, and I'll let you know which zone.
Cool. And what about rate limits? So, this is a topic that a lot of exchanges have different policies on. There has to be some kind of limit in the end. I noticed you have batch order support, which helps to most efficiently use the API. I think you have a dead man switch where you can cancel the orders on disconnect, or do you not have that?
Yeah, we do have a cancel on disconnect.
Yeah, so basically, so you've got the tools for people to like officially use the API, but what do you do for clients that might run into rate limits and need to get a boost?
Yeah, so we're on 200 per second on WebSockets, and you can do all sorts of batching of your orders and your trades. So really, if you're on 200 per second and you need some sort of boost, it's probably because you're trying to quote like 15 markets at the same time. At which point it's super easy to just create a sub account and do those in different sub accounts. So the orders are not across the whole system; they're per sub account. So you can create as many of those as you want, and you're not really going to run into any order issue problems.
And the sub accounts, you could just sort of spin them up in the UIs. I haven't actually.
Yep.
Can you? But are you? So if you create a sub account, can you very easily like flip over to the sub account and back to your main account, or you have to log out and log back in?
Yeah. If you're familiar with FTX, it'll be very similar. But basically there is a window at the top where you can just switch between sub accounts. You can also within the trading interface. You can also within the trading interface transfer funds very easily between sub accounts. And then if you're ever not in the trading interface, you can just go to the top part of the screen while you're logged in and flip between sub accounts.
Cool. And do you have isolated margin if people want to take a maximum leverage of 10x and they want to just control their risk in this way, or is it all just cross margin?
It's all cross margin within one sub account. So each sub account is limited liability. We were thinking about doing isolated margin per position within a sub account, but it gets kind of complex. Really, if you want to limit your risk, just move some of those trades into a different sub account. The other advantage I'll point out from our account structure is, and this just launched, you can create an account with MetaMask. So a lot of venues, a lot of exchanges, and companies in the crypto space still use this kind of email sign up process, which is really slow, and it's a little bit insecure. You know, emails are not at the end of the day super safe. But people have been very used to the speed at which you can do stuff with MetaMask, and also like some people have very good security on their MetaMask. So we thought, why not tag on to the trend of where everything's moving and just allow people to create CoinFLEX accounts with MetaMask. It's way faster than email.
Yeah, that is super cool, and definitely agree on the emails being insecure. I think a lot of us have unfortunately been on the Ledger leak list and a number of other exchange hack lists. So that's, you know, a lot of people getting spammed because of that. It's a lot more secure and preferable to be using something on chain. But so does that mean that you like what are the limitations when it comes to no KYC? Is someone allowed to trade without providing docs, and what are the what's the max withdrawable limits and such?
So right now there's a $10,000 daily withdrawal limit, and without docs. And what we are looking to do, this is in progress right now, is we are decentralizing the custody of CoinFLEX. So what this means is right now you're depositing the CoinFLEX. Ultimately, at the end of the day, this is a Fireblock system. That's the custody partner we work with. That CoinFLEX staff, CoinFLEX employees, CoinFLEX core team members are in control of. This is very similar to how any exchange operates. You know, they have a a custody setup that the employees of the exchange are in control of. The downside of custody setup where the exchange is in control of it is the exchange can do things to your money. It also means that from a regulatory perspective, the exchange is a money service business, or the exchange in the U.S. or other places would qualify as a VASP or money service business or what have you. What we're doing is we're creating a network of nodes that will all receive anonymized risk data around and blockchain data around every transaction. And we're working with a company that's building this with us, but it's using zero knowledge proofs and a network of nodes to basically approve withdrawals. And the benefit of this is it's using all the same checks and balances that CoinFLEX's internal systems use today. Um, but instead of it only being us that's approving them, it's a network of other, in many cases, regulated custodians and entities that will be approving these withdrawals. And the advantage that comes with that is twofold. One is it's way more secure for the customer's perspective because they don't have the risk that CoinFLEX runs away with the money or something happens, and it's more secure from hacking as well. But the other benefit is regulatory because at this point, um, you know, in our view, and everything is an interpretation, but in our view, the onus around uh, source of funds goes away because we're not actually handling client funds. So we're acting as a matching engine, we're acting as a server, but we're not handling customer funds at this point. And so at that point, we should be able to remove all of the KYC limitations and be much more similar to a Uniswap or a Sushi Swap in that there's no obligations to verify an account in terms of documents.
That would be super cool if you guys get it to that point. And the no custody angle of that would be, I think, well, I guess would the user would technically have custody, right? It's just that by spreading it around to these other partners, it's no longer like CoinFLEX managing the custody. Is it fair to call this like self custody for the user?
I think it's very similar in that sense. The it won't be in the sense of if you buy spot Bitcoin on CoinFLEX, it's not like it's immediately going to your MetaMask wallet, but it will be in the sense of like when you deposit to Aave, you are depositing it to a smart contract. Now, those funds are effectively leaving your wallet and going into another wallet, but the wallet is controlled by a smart contract, and you can withdraw at any time. And there are certain smart contractual guarantees around those funds. And so what we're moving to is something effectively very similar to this, where all the funds are matching really fast. It's all high speed from a matching perspective, but from a deposits and withdrawals perspective, it's it's in a network of nodes.
That sounds really cool. It also sounds, yeah, I think a lot of the features that you guys have been working on the past year or so have been obviously inspired by DeFi and a lot of the innovations there. Like when you mentioned this like network of nodes managed, it reminds me of like Ren or other similar projects where you can sort of like, yeah, share the custody amongst nodes in a more decentralized way. And that brings a lot of other benefits. Like, I mean, if you can get it to the point where people are able to spin up an account on there, no KYC, and not have any withdrawal limits, that gets to be a really powerful project, because the performance is not limited by a lot of the things that we see on chain, where you can't really have a performance matching or margining system. But obviously, if you have it running on a server, then it is as as fast as it can be. So you're getting the best of the decentralized world and also the centralized systems.
That is our goal, sir.
Awesome. So FlexUSD, we were talking about before. This is so as you described, just to remind everybody that's listening, that the FlexUSD is a token. So you can basically mint it on CoinFLEX. If you have USDC, you mint it, and 1-to-1. It's a 1-to-1 convertibility window, in and out. So you can go from USDC to FlexUSD, and this does the carry trade that we were talking about earlier, where it will buy spots on whether it's Bitcoin, ETH, Bitcoin Cash, other stuff, and then it will carry the perp rate and try to basically earn a consistent yield on that, and it will have a floor of 0. And is this also a token though? Like, are you able to actually withdraw it from the exchange and use it on chain somewhere in DeFi?
Yeah, so the coolest thing, at least in my mind, about FlexUSD is you can hold it on MetaMask, do things in DeFi with it, trade it on chain, and still earn interest 3 times a day. So you're effectively getting all the benefits of a basis trade in that you have something that's worth $1 and earning interest every 8 hours, but you also can use it as a trading pair or a collateral type in the DeFi ecosystem. So um, that's, I think, the biggest benefit of FlexUSD versus like a BlockFi or Celsius or any of those types of platforms where you stick your stable coins on and earn yield. While you're earning that yield on a centralized platform, you can't do anything with those funds. If you have funds in FlexUSD, I mean, the most basic use case is you can use them as collateral to trade on CoinFLEX, but you can also take them out on MetaMask and do other things with them.
Yeah, I mean, a lot of people here trade on FTX, and if you are lending funds out, like USD out on FTX, you can't actually use that as collateral on new positions. It'll be usable as maintenance margin to like avoid liquidation, but you can't like freely use them as collateral in new positions, which is definitely a restriction. So how does it pay now? It's paying out 3 times a day on Ethereum. So if you have, it's an ERC20 token, where if you put, let's say I have 10,000 Flex USD on CoinFLEX, and I decide, all right, I'm going to pull this out on chain. How am I? Because obviously, if it's a database entry within your system, you're able to easily get credited the Flex USD interest, which compounds. But what happens on chain? Is it kind of like Ampleforth, where there's like a rebasing and you just get more of the token, so it's not like that costly for you in terms of gas?
You guessed it precisely. So the thing I love about DeFi is that you can copy from, you can stand on the shoulders of giants, and when you invent a concept, you can piggyback off of others. So we took the Ampleforth code base, made a few changes to it, and deployed FlexUSD, and it made it that much easier for the auditors, QuantStamp, etc., to certify that FlexUSD's code base and the smart contract is legitimate and works and does what it says it does, and it made it that much easier for us to get up and running. So I mean, we made very few changes to Ampleforth, and that's one of the coolest things about DeFi from my perspective as someone who's building in DeFi.
Cool. So yeah, so basically FlexUSD is not merely a database entry on CoinFLEX on an account that you have there. You can also pull it off on chain, and it will have the same accrual of interest. And just to be clear, just to be clear for everybody, you're not getting USDC interest. You're getting more FlexUSD, which itself is then redeemable for USDC. So let's say you put 10,000 USDC into FlexUSD, and then a year later you've accrued, let's say, I don't know, interest, so that you have 15,000 FlexUSD. There's a one-to-one convertibility window where you can simply redeem those and receive USDC in the same exact amount.
Everything you said is exactly correct. And yeah, like our long-term goal with FlexUSD is for it to be a replacement of Tether and USDC. Like if you just think about macro market structure, Tether and USDC lend out the underlying dollars in traditional financial markets. And so we, the crypto community, give our dollars to Tether or USDC. We hold dollar value in these stable coins, and they take that dollar value and they go lend it out and make the traditional markets more liquid, and they help the traditional markets. But it would be better for the crypto markets if those underlying dollars were actually lent out in crypto, which is the most liquid collateral form. So if you think about a crypto collateralized repo transaction, like a CoinFLEX repo transaction, with these commercial paper and these types of traditional instruments that Tether and USDC are using, they might have a 1 month maturity cycle. They might have a 1 week or a 9 month or a 3 month maturity cycle. With repo, it's a 1 hour maturity cycle, and you're collateralizing it with something that is tradable 24/7 in huge size. You can liquidate as much as you want, and it never stops trading, and it's 1 hour redeemable. So not only are the redeemability and the liquidity of CoinFLEX repo superior to these traditional assets, but also the rates are higher. So I'm pretty sure FlexUSD is kind of paying 5 to 10% these days. The last few weeks, I think it's been earning about 8%, and I'm sure that's way higher than most of the stuff that Tether and USDC are earning. But also, it's more quickly redeemable. So if there is a big rush on Tether or USDC, they may have to sell some of these assets at a loss to the company, because they might be 1 month assets. But FlexUSD is 1 hour redeemable assets. So I think the superiority of crypto lending markets makes it a natural fit. And so long term, our goal is for FlexUSD to replace these other stable coins. And that's not something we're focused on in the short term. But if our exchange becomes the biggest derivatives exchange, it's something I'm pretty sure will happen.
So I agree with you about the point of, obviously USDC and Tether are exposed to commercial paper and other stuff, that there's a maturity mismatch that could arise if there's mass redemptions, and they need to source the liquidity to facilitate those redemptions. But ultimately, you're still connected to USDC. Like people they're creating FlexUSD via minting with USDC, right? So you're still until CoinFLEX connects real dollars, which I know is a loaded term, but so you can't compete away USDC and USDT without there being some dollar replacement that would be used, either real dollars or some other kind of stablecoin that is more easily redeemable in USD, right?
Yeah, this is mostly true. Weirdly enough, you could actually have a scenario where even though FlexUSD is redeemable for USDC, it could become bigger than USDC.
Yeah.
Because really but yeah, this is generally true. We are thinking about this, and the way I would balance it is from a decentralized custody perspective, from the perspective of all those benefits that I talked about earlier, it's probably not possible to connect up to the banking system. And so right now, our view is that at least in the short term, the benefits of decentralized custody way outweigh the benefits of connecting directly to the fiat rails. And maybe I'm scarred from running a fiat exchange for a long time, but I think the freedom that you get from operating primarily on stablecoins is really not something we're interested in giving up either. So yeah.
Yeah, and I think a lot of us that have been trading, not necessarily operating the exchange, but trading in these markets for many years, the pain of dealing with fiat is certainly very high. But tell us a bit about your thoughts on the regulatory environment with stablecoins. We've got the U.S. Regulators like the Federal Reserve, which does play a regulatory role, and these others that are sort of getting worried about the impact of. We got between USDC and Tether, it's something like 100 yards of dollars, which are the yield doesn't come for free in traditional markets. They have to be able to get it from probably most of it the commercial paper market, and they're starting to get worried that it's going to destabilize their markets. And what happens if there's regulation coming where let me paint a hypothetical for you and how you guys would react to it. So back in the day with PayPal, you used to actually be able to send dollar balances in their system to any email address that you wanted without any KYC or anything like that. And the standards that these guys have implemented on PayPal and many other similar money transfer networks is that you can send the dollars to whoever, but you have to do proper KYC AML. So maybe, hypothetically, let's say that they enforce a whitelist on all USDC and USDT transfers so that you can only move them to some KYC approved address. How would this, first of all, do you think this is a plausible scenario? If not, what do you think is coming in terms of the regulatory environment? And third, how would you guys deal with it at CoinFLEX, since you are obviously taking a big bet on stablecoins being growing more and more in the future?
Yeah, I mean, I think it's hard. It's hard to, first of all, I would say it's hard to predict what the Fed is thinking, but I think they have a balance of interests in that on the margins, stablecoins actually proliferate dollar dominance in FX markets. So maybe, I don't know how widely this is known in crypto, but Tether and others are now, becoming somewhat active tools in international global trade. So, settlements between like Russia and Brazil and other countries in terms of their corporate users and their businesses are often being done in stablecoins because it's just easier. 24/7, you don't miss out on 30% of the week in terms of weekend closures and stuff like that. So, I mean, I think the governments have like three questions, which is one, how much do they like the benefits of the dollar proliferation that the U.S. government ultimately benefits from in terms of seniorage and the ability to print money, and that's marginally increased with stablecoins. It's not hugely increased. It's not like this matters that much, but 100 billion, it definitely is a marginal increase. So that's one. Then they have to figure out, there is a lower AML standard in on-chain transactions between two participants in USDC, and so they have to figure out, well, is this a regulatory arbitrage, and if so, is it something that we need to close, or do we care enough about it, or is the benefit of number one outweighing the cost of this regulatory arbitrage? And then the third one is like, how would you go about and implementing that whitelist? And what you just said is one way to do it. But that whitelist will directly impact the usability of stablecoins in international commerce. So I think that's ultimately going to be their decision that they have to make. And I think the advantage that the stablecoins have is that they've just grown so ridiculously fast while being effectively regulated as MSBs. There was no stablecoin specific regulation that was invented for this specific use case. So they kind of pigeonholed themselves into MSBs and classifying all the on-chain activity as effectively not having to do with the MSB provider. So if you made a tweak to that interpretation and you interpreted all the on-chain activity as being under the onus of Circle and Tether Limited, etc., then I think it would drastically change the attractiveness of these offerings. You'd still get the added benefit of the weekend coverage, but you'd lose a lot of the frictionlessness of these stablecoins. And then it's a question of, is there even the ability to KYC the sheer number of users that these stablecoins have today? So I don't know which way it's going to go. I think we're likely going to have the onus be more on the exchanges and the money service businesses and the VASPs, and also the entry and exit redemption points of the stablecoins themselves. But I think if they, if they continue to grow as a percentage of commerce and as a percentage of the dollar supply, I mean, right now, 100 billion, it's a lot of money. In terms of the total money supply, close to 100 trillion, it's still pretty small. So if it got drastically bigger, I think that also changes the question as well. And it, unfortunately, it changes it on both the proliferation side and the AML risks side. So it's unclear which direction they'll go, even at a higher market cap size.
Yeah, and I think that so far Circle and Tether have sort of gotten away with, for lack of a better term, saying that we're very strict on the entry point and the exit point. Like if you want to provide dollars to mint or to provide tokens to get dollars for redemption, then it's pretty strict KYC AML. You're not doing that anonymously. Like if you're trying to use them as the conversion point. But any kind of censorship or any kind of enforcement of a KYC AML, like if they find out ex post facto that some ISIS member or someone in Iran or whatever has received USDC and USDT, then of course the compliance departments there can blacklist them after the fact. But then that regime, that's the current regime. That's how things are working. And whether or not regulators are content with that, or if they are going to basically say, no, that's not enough. You have to actually, before somebody's able to receive any of these tokens, they would have to KYC. That would definitely be a huge blow to DeFi, because unless you just have a whole like civic style identity regiment where you are able to do some kind of lookup to see if somebody is KYC'd and not on any kind of like banned list. It would totally change the use case of stablecoins if it went in that direction. In my opinion, it would be quite a shame for the whole industry if that would happen.
It would be a massive shame. I think you're right. It would probably kill most of DeFi, and I think it would also harm a lot of the legitimate business use that stablecoins are having outside of crypto entirely. That doesn't get reported on, but I do hear about it from a lot of folks here in Hong Kong and abroad. And so it would be a massive shame, but they may decide that they don't care. So we'll see. But I'm pretty bullish. I think regardless of which decision they take on this front, stablecoins are going to continue being really amazing. This would definitely curtail it, but they are just drastically superior to bank wires and bank balances directly.
Yeah, and as we have just the last point I'll make on this, and then I want to move on to notes. But when it comes to the benefits you're describing for the US dollar hegemony, I think regulators should really understand that. If they're going to crack down and I think continue to use sanctions as a weapon, like they have been doing against a lot of Russia, China, etc., it's actually to their detriment. If they keep trying to flex, and no pun intended, if they keep trying to flex on the international scene, and the US is getting, I would say, relatively weaker, on the geopolitical front. And if they keep trying to like overextend and say, oh, we're gonna keep using our US dollar hegemony to sanction people and do this kind of stuff, it's going to be to their detriment. I think it's going to make it so that people don't want to use USD, and then alternatives will rise. And before you know it, instead of FlexUSD, there's going to be some kind of like, I don't know, Flex Ruble or some other fiat regime which is more friendly to this kind of like freedom in the wild transfer mechanism. And I think for crypto this would also be super beneficial. I mean, I think it's nice to have a hegemonic currency, because everyone has the same sort of anchor for value. When everyone's talking about value in the financial markets, having USD as the sort of basic reference is I think it makes speaking the same language in finance a lot easier. But at the same time, for crypto, if we can sort of put various fiat regimes against one another, that gives us more leverage as well to have the kind of systems that we want.
Definitely.
Okay, cool. Notes. Let's talk about notes. You at CoinFLEX have, for a number of market makers, you've issued sort of, I don't know if I'm using the right words, but promissory notes have been issued to a variety of players like Nibio, Grapefruit, eFrontier, where basically these are market makers that are borrowing at rates of between 5% and 9%, where users are able to provide USDC to them, and they're basically borrowing at, it's more like a traditional note or like a bond, where they're borrowing and they're paying some kind of rate every, I don't know if it's every month or every 6 months or a year, and then they use those funds to market make and to generate their own kind of yield in the markets. Can you tell us a bit about how this product works? And the last time I saw one of these notes issued was in March. Is there any plans for more notes to be issued? And like, how has this been performing as a product?
Yeah, so this is one of our most interesting products. We realized that promissory notes, which in the 1800s were a very large actual form of money in the U.S., different businesses and going back in various points of history, different businesses issued promissory notes. And because of a lot of this history, they have a legal background as being not securities. So you can issue a promissory note, and in the UK, in Hong Kong, in Seychelles, in a bunch of different places, pretty much all around the world, they're not considered securities if they're less than 9 months. So we realized, well, we can tokenize this. The fundamental thing is not a security. The token is not going to be a security, and because it's not a security, it can be traded by anyone. It can also be traded in DeFi. Can be purchased in a wide variety of ways, and the value is huge for a trading firm, because if you can borrow unsecured for a 1 month basis and then just roll that and roll that and roll that, it gives you working capital that you can use to trade. So we realized they had huge value to the borrower. And what we also realized from the notes is that if we focus on creating sort of like a buffet of options for passive capital to deploy capital into, passive capital is very sticky. So by passive capital, I mean, let's say someone mints FlexUSD and they just sit on it for a month or 3 months or 6 months. It's very sticky. These are customers that don't leave. They are very long-term minded. They're not like a degen trader that just comes in, buys a bunch of perps, sells a bunch of perps, eventually gets liquidated, and then they're no longer a customer anymore. So notes, we realized, was going to be a key part of that, because if you think about the spectrum of yield, FlexUSD is kind of like the collateralized yield, very safe. Eventually, you want to get to the uncollateralized corporate kind of lending markets as well. And in many ways, it's very similar, almost exactly the same thing, to commercial paper. And so these note tokens are interesting. I think are going to be one of our most important long-term markets in terms of dominance of the exchange. They are something that probably will take many years to take off. They're not going to be a very quick takeoff market. FlexUSD has been something that's gotten adoption much faster, and I think our AMM will get well. Our AMM is getting very quick adoption. The last few weeks, it's grown significantly since we just launched it, and so it's kind of like along the spectrum of passive capital products, it probably will take off the last, but it will take off because also the note holders get a percentage of the trading fees of the firm. So when we're doing billions of dollars a day, if you buy the notes of the highest volume trading firms, you're going to get a pretty big kickback in the form of this trading fee incentive, and that kickback could be just as high or higher than the actual interest rate itself. So at scale, they become something that's very compelling to buy and really has a lot of advantages for both the buyer and the borrower.
But so unlike the FlexUSD though, you can't just sort of once you have a promissory note token, you can't just redeem it for USDC. You have to sell it on the market.
You can sell it on the market, or you can redeem it once a month for USDC. So they are redeemable, but it's a longer duration period than FlexUSD. FlexUSD is redeemable every 8 hours, 1-to-1. This is redeemable every month, 1-to-1.
Got it. And are you saying that this is a perpetual note that rolls over every month, or there's a you said under? Okay, so it's not. You said something about under 9 months, but it's not. Like, what happens if a bunch of people are redeeming, and the market maker want to have capital, right? So how are they getting more of the USDC that they need?
Yeah, so I mean, the right to redeem is the key thing. So the right to redeem every 30 days, and the duration is really every 30 days. If the market maker doesn't have the cash, they're in default, and the CoinFLEX entity that's issuing these notes will have to sue them. So and that's the risk the buyer takes. The buyer assumes that risk. And that's why we've been very careful about who we've been able to issue these notes for. But it is ultimately basically the market maker has to come up with the cash. That's where the longer the duration, it would be more valuable for the market making firm, and the shorter the duration, it's more valuable for the note holder.
So theoretically, they could have to cough up all of the USDC at the end of the month.
Exactly.
So you haven't had to sue any of these guys yet?
No.
All right. Okay. I've been saving the best for relatively last, the AMM product. But before we get into the AMM, because I think normally when people think AMM, they think like Uniswap and DeFi. This AMM approach, automated market making, is sort of it was sort of a hack, I think, initially on Ethereum, because you can't have a on-chain functional order book market. So this was sort of a way for having a spot swap trading, where you swap from one asset to another and having liquidity that is available there. But so before we get into that though, what do you think? So because CoinFLEX has been around since 2018, you have a number of I'm just looking on the exchange. How many swap pairs do you have in total? Is it something like 15, 20 pairs?
Over 30 pairs, yeah.
Over 30 pairs. Okay, so you got a healthy array of pairs that are there, not just the big coins, Bitcoin and ETH, but also much further down the line to Doge and certain DeFi coins. You have the deliverable perps, you have spots, you have fixed maturity, traditional futures, spreads. You even have these the funding rate futures as well, the index futures. So you have plenty of products on there. But when you look at the market share of CoinFLEX compared to the big dogs like Binance, Bybit, OKX, WoBTM, And then FTX has been more of an up-and-comer. What do you think has held CoinFLEX back in terms of rising in the market against some of these competitors? Like, what ingredients are you guys missing? Because you have a pretty decent product offering. You got multi-collateral system. What is it that prevents you guys from being a like top 5 derivatives exchange out there?
Yeah, so I think the biggest thing was liquidity historically. And I think a lot of people knew about us, a lot of people trust us. We have kind of an extremely long background in the space. And our tech team has really grown significantly and been able to respond to product requests a lot faster. And so we've kind of caught up a lot in that sense. But the biggest thing was liquidity. So I think we have one of the best products out there. But at the end of the day, from a trader's perspective, if Binance perps are more liquid, then someone's going to trade on Binance perps rather than CoinFlex's perps. So at the end of the day, that's the truth, and that's something that as a smaller exchange you have to fight against, and you have to find a way to beat these network effects. And if you can't, the eventual outcome is death. So what we've realized is there is a type of user that is happy to earn yield on their coins or their dollars from just the price movements of crypto. So obviously FlexUSD is a way to earn yield from repo and perp funding and all that. But there's another type of user that was popularized and realized by Uniswap. And Uniswap is 100,000 LPs. So LPs on Uniswap are using their automated market maker product. And effectively, these are people that are putting up dollars and Bitcoin, wrapped Bitcoin, or dollars and ETH, and they're happy to buy or sell at any time of day blindly at the current prevailing market price. And when as the price goes down, they buy more, and as the price goes up, they slowly sell out of their holdings. And so what they're really betting on is they're betting on a range bound market and lots of Uniswap volume. So if they put their liquidity in at 2,000 per ETH goes down to 1,500 and up to 2,500 and then straight back to 2,000, and billions and billions of dollars have traded. These AMM users make a ton of money. And so what we've realized is this is actually a great product and a great style of trading, separate to whether it's on a blockchain or not. So you can do the same thing on CoinFLEX. If you just go to coinflex.com/AMM, plug in your assets. Again, you can use MetaMask to sign up, plug in your assets, and you can do the same style of trading where you're just passively providing liquidity in Bitcoin or ETH or BCH or any type of market. And the advantage we have over Uniswap is that from a Uniswap's perspective, a user has to put up dollars and the coin. So USDC and wrapped Bitcoin, let's say, if you want to make markets in that pair. Well, on CoinFLEX, we allow multiple things to be used as collateral. So you could just put up Bitcoin and make two-way markets in Bitcoin. So you're buying on the way down and selling out on the way up. And because we can have it extremely configurable, you could even have it where you put up Bitcoin and then you're just buying on the way down, selling out on the way up, but you never sell out more than your 1x leverage long position. So you retain your core Bitcoin position that you're collateralizing with, and you just buy more Bitcoin and sell out of your Bitcoin.
Well, sorry, Mark, just one thing I want to clarify there for people listening. So on Uniswap, there's not derivatives for people to be making markets on, right? So it's token
Exactly.
A and token B, and then swapping between token A and token B. What you're describing with the any collateral stuff is doing an AMM on CoinFLEX on derivatives, where you can just put a single asset in, and then that can be used as collateral to make two-way markets. But you also have a spot. You have spot markets, right? And you can also provide traditional Uniswap liquidity by not just, you can't only provide Bitcoin on the spot, if I understand correctly, the spot AMM, you have to actually provide Bitcoin and USDC, just like it would be Uniswap. Is that correct?
No, so that's not exactly correct. So actually, you're providing in our perps, and then because our repo market is a spread market between spot and perps, you're also providing in our spot. So this is one of the coolest things about it as well, is if you provide in Uniswap, the only people that trade with you are people trading spot on the blockchain. If you provide liquidity on CoinFLEX's AMM, the people trading with you are, one, people trading perps, but they're also people who are trading CoinFLEX spot, because the repo market shows the prices of the perps into the spot market as well. So if someone buys Bitcoin and you're providing in that AMM, someone buys Bitcoin on our spot market, they might trade against you. If someone buys Bitcoin perps, they might trade against you. And you can do this in an unleveraged way where you'll never pay perp funding, even though you are trading perps. Again, that's because of delivery. You're always just delivering, and so you never pay funding. Or you can do it in a leveraged way. And if you do it in a leveraged way, you're also going to be benefiting from FlexUSD, which is going to keep the rates nice and low for you.
Okay. So that's because I was playing around with the tool, and I can see now looking at it that there's a leveraged tab and unleveraged. And if it's unleveraged, then you're putting in either side of the trading pair. So if it's BTC USD,
exactly,
then it's more like Uniswap. But if you do it leveraged, then you just pick a form of collateral which will be locked in to this in order to provide it. Okay, now that makes sense. I guess it was a bit confusing because in the leveraged one you can be 1x, which to me is the same as unleveraged, but I guess I understand how it's working there.
Yeah, you can see someone might want to be 1x, but they're buying only, and so they're really like using their Bitcoin to buy more Bitcoin and sell out of the extra Bitcoin that they bought. So that's actually been one of the most popular trades people have done. So they put in their crypto and then they do buy only, which means you're going to be buying and selling, but you're never going to sell out of your original Bitcoin deposit or ETH deposit or BCH deposit. You're just going to be buying more and selling out of the perp position. And that's been a really popular one for people who want to kind of provide dip buying liquidity and earn some yield on their core crypto assets.
So no matter what with this AMM, it's starting in the perp markets, and because of this relationship between spot, repo, and deliverable perps that we discussed at the beginning of the chat, that when you're in the perp market, this is actually implying liquidity into the repo and spot markets as well. That's all connected.
Yeah, exactly. And the cool thing about it is, if you just want to be a user, it's like Satoshi said, users can just be users. So if you just want to be a user, you can just go to coinflex.com/AMM. Literally, you don't have to think about any of this repo stuff, any of this perp stuff even. You don't even have to understand perps. And you just set your range, set what you want to do, and begin. And so we have a lot of stuff going on behind the scenes that makes the yields higher, makes the costs lower, makes the funding rates cheaper. But at the end of the day, if users just want to be casual, they can do that. And so far, the nice thing about it is everyone who's used it, it's been really sticky. They've redeployed when markets moved out of their range, but they've basically generally it's been up only from an asset growth perspective.
And so one of the things about AMMs is that the price doesn't move unless somebody is taking liquidity, right? So Uniswap, if theoretically nobody traded on Uniswap, then the price would just sort of stay static. But because markets outside of Uniswap move, then there is this incentive for people to arb between a sort of sticky price on Uniswap and a moving price on outside of Uniswap. And that's the similar idea that you have on CoinFLEX, right? If you're providing liquidity, so just so that people understand, when you use CoinFLEX's AMM, you put your desired parameters in there of what collateral to use, how much leverage, whether you want to be sort of biased long or short or neutral. Then as soon as you put that in, it's not a swap feature. People aren't just doing the swap that goes into this AMM, but it's actually projecting, it's creating orders on the underlying order book from the liquidity that you put in there. So it's basically like, step one, you put in the liquidity into AMM. on CoinFLEX. And then step 2, once you have executed it, then behind the scenes, CoinFLEX is, I imagine it's like a sub account of sorts, which is using the capital that you put in there. And then CoinFLEX's system is creating the orders on either side in the book, reflecting that. So if it was completely empty, so if we started like a Bitcoin USD perp order book, and then nobody's in there, let's assume there's zero liquidity, and then somebody goes in and puts like, you know, 1 Bitcoin into this AMM thing, then it would suddenly create double-sided liquidity in that empty order book after somebody has put in their liquidity on the AMM. Is that right?
Yeah, that's exactly correct. And the nice thing about this is, from the AMM's perspective, you can see every single order that the sub account, and it is using a sub account. It's CoinFLEX kind of managed sub account that gets created. You can see every order that sub account is running. You can see every trade that's been done within the interface, and yeah, you are effectively trying to get arbed. So your goal is to provide liquidity. You don't really care whether it's coming from arbitrageurs or whether it's coming from someone else, as long as every time you buy, there's an order that appears that is higher than that to sell out, and those two are matching. You have you have a bunch of scalps that you're doing. So you want actually as much arbitrage volume as possible. And this is one of the problems with Uniswap. No matter how much volume is being done on Uniswap, there's 12-second block times. So, you can't have multiple trades go on within one block. And on CoinFLEX, you could have 1,000 trades in 1 second. You could have many, many trades in 1 second. And so the end result is that this creates liquidity directly on order books with the fastest participants in the market taking advantage of that liquidity in an area where within the time that ETH might have only 1 trade, your AMM on CoinFLEX might have had 100 trades. And so the yield is that much higher because the volumes are much higher. And we're already seeing that Uniswap is generally 1-to-1. $1 of liquidity trades about $1 a day. Sometimes it's 50 cents a day. We're typically 5-to-1, sometimes even 10-to-1. So $1 trades $5 or $10 per day.
And basically, it's earning on the fee structure that you have on CoinFLEX is a sort of traditional maker-taker model where the maker side earns a rebate. So all that liquidity, once you're starting the AMM, that's all of it that's getting taken or hit by others. The equivalent of the Uniswap LP fees is the actual maker rebate that one earns on CoinFLEX.
Yeah, exactly. So this is where FlexCoin comes in, and FlexCoin is obviously our coolest product and is in line with the kind of passive capital approach that we have, which is, there's going to be ways very soon to invest in Flex and also earn a yield on it via a staking kind of DAO system. But FlexCoin is the thing that fees are paid in. So traders that are trading against other participants who might be the AMM or they might be other market makers pay in Flex, and then makers earn in Flex. And so it's 4 to 8 bips taker fees, and the highest rebate is 3 bips. And the AMMs, you have to do a lot of volume or own a lot of FlexCoin to get on that highest fee level and earn that 3 bips. But if you AMM, you automatically get to that highest level. So you earn that 3 bips, and then the takers pay that 4 to 8 bips.
Yeah, I actually, a few hours before this, I decided to kick up a AMM strategy on CoinFLEX. I decided to use BCH USD perpetual just because I saw that there was, I don't know what's going on there on CoinFLEX, but the volume on BCH USD seems way higher than everywhere else. So I thought from a liquidity provider perspective, that's probably the best choice for me to earn the most rebates, is that there seems to be the most taking, the most action going on there. So I decided to choose BCH USD. I know a lot of people are going to hate me for that, but I have been for 3 hours providing liquidity there. And I can see the open orders, just like you said. If I go to this open orders tab, it shows the buys and the sells that are open. It shows the trading history. I think, just as a pro tip or point of feedback for you, it would be cool if there was more of a visual, like you showed the order book and showed the open orders active there, and then you could see them getting hit, and as if you're
that'd
watching.
Be delicious. Yes.
Like you're watching a robot trade in front of you for you. That would be pretty cool to watch, right?
Yes.
But so I've already, it says here, I've already got a APR of 63% within the past. Well, I mean, APR is prorated anyway, but I'm currently, after 3 hours, earning a 63% APR, and it's so yeah, it's just like Uniswap V3, right? So Uniswap V2, as most people listening, most people here hanging out know that Uniswap V2 was like the lazy 0 to infinity constant product function market maker. Uniswap V3 introduced this range where you could say, I want to provide liquidity, for example, on USDT to USDC. There's never any trades that happen more outside of like a 1% range. So it makes most sense to be providing liquidity within a tighter range. And that's basically what CoinFLEX is doing, right? So you choose a range. Say on BCH USD, I chose a range between 430 to 460 or something, and it basically just posts orders there, and it's sort of let me see, it's sort of like laddered in a way, I guess, that it's the buys and the sells are stretching across, right?
Yeah, exactly. It's just spread out based on your size and the range you do. So we just take the total amount of buys you're willing to do, the total amount of sells you're willing to do, and we spread it out in a very simple way. At the end of the day, this is automated trading on behalf of users, and we're not trying to do anything fancy, anything special. So it's very similar to Uniswap V3. The goal is to be very intuitive. We just take the size that you're willing to buy, spread it across evenly between the min price and the mid, and do the same opposite thing for the size you're willing to sell. And it makes it very simple. So if you're towards the bottom of your range, you're going to be mostly deployed. If you're at the bottom of the range, you're going to be fully deployed on the long side, and the opposite on the top of the range. So it makes it kind of easy to think about effectively.
And so why I think it's a cool product overall. Like, I mean, like as we talked about before, that you can innovate with as many different things to trade as possible, but if there's no liquidity, and I know you guys have Grapefruit, Mike Komaranski, B2C2, these are all publicly listed as investors and supporters of CoinFLEX. For whatever reason, they're not packing the books, and they're not taking on that sort of anchor liquidity role, or at least maybe they're not doing it as so aggressively as, say, Alameda is for FTX. But they're using this AMM, which obviously is a DeFi sort of innovation, and then applying it in such a way where you don't have a swap mechanism, like people aren't coming in, which I don't know if you do, but it might make sense also even to let retail guys use something that's just like, let me swap 1,000 USDC for BTC, and then that could go into the order book or the AMM as well, just to add a bit more flow into the market. But yeah, overall, getting users who are they're more and more accustomed to using AMM and DeFi, but getting them to use it in a centralized context, and then that packs the books. This seems like an elegant solution to the liquidity problem that an otherwise innovative product line is facing at your guys' exchange.
Yeah, exactly. Our thinking is we looked at the fact that there's 100, and I keep thinking about this all the time, every day. There's 100,000 people providing liquidity on Uniswap. That is more. I'm 90% sure this is true. That is more market makers than any centralized exchange in crypto or in traditional finance. So if you just think about the CME and the number of manual or automated market makers that are on the CME, and then you think about BitMEX, and then you think about Binance, a lot of these markets that are dominated by electronic market makers have maybe 100 market makers that do the majority of the volume. And they're all trying to buy below fair value and sell above, right? So they're all trying to not get picked off. They're trying to do these things. And then if you think about the amount, and also just think about the high frequency and market making space in terms of them as an asset class, it's probably a sub-trillion-dollar asset class. So if you think about it's kind of, most people don't think about market making as an asset class, but it's definitely a sub-trillion-dollar asset class. It might even be a sub 100 billion or 200 billion-dollar asset class, in terms of the investments that mostly individuals make with their own money into their market making algos. Um, and then if you think about the money that goes into index funds, the money that goes into all these passive strategies, it's trillions and trillions, or even tens of trillions of dollars. Um, Equities, bonds, and other forms of passive capital strategies. And I think nowadays, with the Fed and other markets driving rates to zero, in terms of yield, people are looking for other ways to get yield. So
Yeah.
the world wants yield at the end of the day. And if you're willing to hold crypto exposure, you might also be willing to sell out of that crypto exposure at higher prices, in which case you can do a sell only AMM with crypto that you have. If you have dollars and you're willing to buy a little bit more crypto, you could do a buy only AMM. If you've got a mixture of both, you can do a neutral strategy. But at the end of the day, people want yield. This is a way that you could deploy 5-10% of your capital into a low risk strategy that market makes around the current price. And the yields, I mean, as you said, you spun one up a few hours ago and it was 63% annualized. You know, imagine what the yield is going to be by the end of the 24-hour period. You know, we don't take the 3 hours and annual and times whatever it would be to make it 24 and then annualize that. We just they do the first day and then annualize that. So um 63%, this is much better than almost anything else, any other passive capital strategy. And so the AMM, depending on the width of your range and certain things, it might be something that someone does very actively. You could be very aggressive with it, or it could be extremely passive. You can have a very wide range. But it is an opportunity for people to get involved in a form of yield that isn't just the basis trade and isn't just buying bonds and isn't just buying stocks. And it's a way of earning yield on your crypto as well, where you can do FlexUSD, but at the end of the day, a lot of us are in crypto because we don't really like holding lots of fiat. So why not earn yield on Bitcoin and ETH and BCH and other coins as well? So yeah,
Right.
it's
So so most of the taking though, so it sounds like there's a significant amount of the liquidity in your order books now that are coming from passive liquidity providers, and I agree with all the points you made. I think this story which has emerged over the past years about reaching for yield. I mean, us in Europe, we've actually been dealing with negative interest rates on fiat, which has led to a lot of people in this part of the world getting into crypto and protecting their capital from basically just it's being destroyed otherwise. Even if you're buying German bonds and other bonds, you're actually paying people you're not receiving interest from them, you're paying them. It's just everything's upside down, right? Yeah. So this reach for yield, like I feel it in my everyday life, just even talking to normies that aren't into crypto, and it's a really easy conversation getting people who are otherwise scared of crypto because of all of the stuff they've heard about hacks and this and that. And if you just tell them, like, actually there's some pretty innovative ways to get a return on your assets, like it's a nice way to ease people into the space. I've found in my own personal experience getting people into the space. But so just like with the Uniswap yield, though, like the yield has to come from somewhere, and in the end, there are takers on CoinFLEX that are buying from the passive liquidity providers, and who are the takers? Like, who is actually coming in and buying from me?
Yeah, so I mean, right now, a lot of it is arbitrage. The price of, I mean, you're doing BCH, the price of BCH goes up and down. People are arbitraging your prices. And I think that's actually quite a win-win scenario, because one person, the AMM, is playing a long game. You might be betting that it's mean reverting and then it reverts to some price. You might be doing a dip buying strategy. You might be doing something that looks kind of similar to a covered call by doing a sell only strategy. So the AMM is doing some sort of long game, and then the arbitrage firm or the algo trader is doing some sort of short term game. They're buying on CoinFLEX, selling somewhere else. They make an instant profit. So the AMM makes a longer term profit, and the arbitrage firm makes a shorter term profit. The thing that gets me really interested about this is, if when we get to $1 billion in TVL in this AMM, our Bitcoin liquidity will be better than Binance's Bitcoin liquidity. So I think that'll happen even well before that. But once we get to $1 billion in TVL, it'll be way better than Binance's perps, at least for the top of book. Maybe not 1% wide. They might have 60 million and we only have, 20 million or something. But at least for the top of book, the top 5 price levels that people see when they open up the trading interface. And I actually think that top of book matters way more than the 1% level. So the prices where they matter most already for BCH, because we've got a lot of BCH whales and they're putting money into AMM, and we have a lot of BCH users that do that. Already for BCH, our markets are more liquid than some of the biggest exchanges in the world. If we get there for Bitcoin, you'll see our perps being more liquid than the biggest exchanges in the world. At that point, it becomes very easy to convince all the most active traders, whether they're retail or institutional, hey, CoinFLEX not only has the tightest liquidity, but you can also take the perps and just convert them to spot in one click. You can also often get the best funding rates because we have this stablecoin that's lending into our funding markets. And so the perp funding you're going to pay here to be long is less than everywhere else. And so at that point, it becomes very easy to convince these traders to switch to CoinFLEX, where right now the focus is on AMM users. At that point, the focus will be on actual traders directionally trading themselves. Yeah, the flow,
the
exactly.
Traditional flow. Yeah, because, and I just posted a link in the chat for people to see. I think it's visible even if you don't have an account. This transparency page, and the TVL, total value locked, at the moment is over 16 million bucks. So just so people have context there. BCH, now I understand why there's so much volume there, because the TVL of on the AMM side is 16 million. So the vast majority of I guess it's maybe Roger, Ver, or Mike that are putting in a bunch of assets in there to provide liquidity. And that means there's a lot of, it's almost like, I don't know, I don't want to call it dumb money, because that's, I think it is a good strategy if you're short gamma in this kind of trend, this kind of non-trending market. It's not dumb money, but in the end, you are sort of providing liquidity at prices that are profitable for someone to arbitrage, which implicitly is kind of like a bit of dumb money in a way. So there's all this liquidity in the books from whoever it is. Hello, Roger. I hope you're doing well. Maybe that is providing liquidity, and then someone on the other side is just willing to take it, and that's generating the volume. So it's kind of like, it's like you've flipped the tables around of what normally exchanges are dealing with. Like normally you're trying to beg market makers, please put liquidity in our books, and then you have to go find directional traders, punters out there to go long or short. But in this case, you're sort of get those people who normally would be going long or short and tell them, put the money in the AMM, and then you'll be providing liquidity in the books. And then those LPs, the market makers that normally would be the ones passively providing liquidity, they're doing the arbing instead, which is like totally turned everything upside down in terms of normal dynamics.
Well, we realized after begging market makers for years and years, put up prices, that these guys are going to put up prices, but they're going to put up prices that are favorable to them. They're not tight. They're not as tight as other exchanges. Look at the walls on Bybit. Look at the walls on Binance. They're big, thick walls, and they're not coming from people that are just looking to buy and sell, above and below fair value. They're coming from people that are in positions and trying to get out. So this is a way to circumvent that liquidity network effect and build up our own proprietary liquidity network effect that doesn't give a shit about what the price is on external markets. It's just looking to make money domestically on CoinFLEX. And then if that gets big enough, we become the biggest market. So, and partly what we're trying to do, we're doing a bit of this with Axes, and we're obviously doing this with BCH. We want to do this with DOT. Partly what we're trying to do is take a few coins that we know some communities. I mean, we've got probably 100 users now in BCH that are providing liquidity, and like loads of users in a lot of these other AMMs. So in a way, we have more market makers now than we've ever had before. Algo market makers on any top exchange, like any of the top 5 exchanges, probably have less than 100 algo market makers that do 90% of the volume. So we have in a way more than that now, and so it's a way to dominate a few coins quickly, and then obviously in the long run we want our Bitcoin and our ETH liquidity to be the biggest in the world as well. But that's sort of one of those things that comes when those ETH whales and BTC whales kind of find out that they can make a ton of yield from this product as well.
So far this has been, I think, fantastic in this market environment where things are choppy, range bound. I think this is an extremely strong product. But what happens when we are in a sort of early 2021 kind of market where it's just, everything's going up? A lot of these liquidity providers will be a bit wrecked. I mean, obviously you give them the opportunity to customize their liquidity provision and take the risk that they're willing to take based on what assets they're providing, whether they want to be leveraged or not, whether they're biased long or short, or they try to stay neutral. But this is not a great strategy overall in a trending market, whether it's up or down overall. So how do you think that you'll manage the market environment when it inevitably does change? Like shorting gamma isn't always a great trade. At the moment it is. So how do you think this is going to survive in different environments?
Well, one of the cool things is, again, like one of the most popular strategies is a coin collateralized buy only strategy. And you can do that where your mid is even above the market, so you end up immediately getting long when someone deploys this strategy. And the cool thing about doing it like this is, in an up only market, if you just held the crypto, you would make X amount of money from an X percentage gain. So if the percentage gain is 100%, you'll make 100% times your money, right? If you hold the crypto and deploy it into a buy only AMM, you'll make way more money, because you'll make the gain of the spot asset that you're collateralizing your trades with, but you'll also make the gamma from the volatility from that type of market. And so it is one of those strategies where it can work for many, many market dynamics. Obviously, range bound is generally the best market dynamic for this AMM, but it can work really well in an up only market too. It can work really well in a down only market too. And this is why what we want is to bring in lots of participants, many who are bearish, many who are bullish, many who are neutral, and that divergence of views gives you a consistent order book in across all market conditions. So if we have 100,000 market makers using our AMM in a similar way to Uniswap, then we have something where, in any market condition, there's top of book liquidity that beats out Binance and the other derivatives exchanges.
Yeah, I mean, I think I was looking around at other exchanges. There really aren't any, at least that I could find, centralized exchanges which are setting up AMMs in a similar way, where you're actually allowing users to provide into an AMM which projects liquidity onto the centralized exchanges order books. There's some other ones that are doing like robo strategies where you can passively just throw cash into a strategy and it will do some kind of automated trading for you. I've seen stuff like that, but not in this kind of way where, which in my opinion is a pretty obvious solution to the issues that CoinFLEX has had over the years and many other smaller exchanges have been battling. What do you think is going to happen? Like right now, this is really novel and very, I think, interesting. But what about if this catches on and then other exchanges start to do the same? How are you going to? Are you worried about this, or how are you going to sort of stand out versus the copycats that might come along?
Yeah, I think one of the things that's difficult about the cash settled derivatives exchanges copying this product is it's very easy to uh, game funding if you know a player is um, always going to be doing certain things. You can really game fund it and behaving in this kind of, as you say, kind of dumb way. You can really game the funding rates such that you know the AMM user will be paying sky high funding one way or the other, and that's fine when you're a bunch of professional algo firms that are paying these funding rates, because you can defend against it. You can close out a position or something and replicate it on another exchange. But if you're an AMM, you know you're off on the beach. You're not looking at your trading. You're not trading on other venues. You literally can't replicate your position somewhere else, nor are you even paying attention to it. So that's really where the importance of delivery comes in, because not in the sense that you really want to deliver. Maybe you want to be leveraged and you don't want to deliver, but even just from the perspective of avoiding funding being really high. Like just the other day we saw Axie's funding on Binance and other exchanges go to 200% annualized, 300% annualized, right? And that whole time we listed Axie's just before that whole spike. That whole time, the highest or lowest funding rate of Axie's on CoinFLEX was under 10% annualized. I think it was about 5 or 6% annualized. And again, that's just because of physical delivery. We had players with Axie's, we had players with dollars. It capped the rates, and in a similar way, when Binance in April and May was 100% annualized, I think the highest CoinFLEX got to was about 40. And I think with FlexUSD getting bigger, if we had another period of high funding rates on Binance, CoinFLEX would probably be would be capped even lower, probably at 15 or 20% maximum. So I think other exchanges can definitely copy this product, but it isn't just this product that's why this product is going to win. It's the underlying repo methodology, it's the underlying power of FlexUSD, and it's the fact that all these things are connected together, and it's the fact that you can use MetaMask to sign up. If a Binance were or someone else were to copy this, they still have this old clunky email sign up process, and maybe everyone's an account holder there. But for the people that aren't and that might be migrating from Uniswap, they want something they're familiar with. That's why we've given them MetaMask sign up.
Yeah, I mean, I think that the vision that you guys have put together from the beginning about Deliverable, and then with this passive yield product, and then now with this AMM, about the passive yield product, I mean, FlexUSD, and all the stuff that you guys are building up to, it's now, I think that there's a really solid plan executing on this, and I think it's a decent point about the Deliverable sort of adding a check on things, so you're not in a situation where people could sort of game the dumb money as much if there was cash settled exchanges trying to do this. So yeah, I mean, I think it really does. It's all sort of coming together there. So one more thing that I would like to zoom a bit more on is the Flex token. So we've, I think, hit on all the products you're offering, all the newer stuff that you've been coming out with recently, the novelty of the system that you put together. But let's talk more about Flex Coin. So this is, I would say, not necessarily like every other exchange token out there. So maybe you can talk a bit about what its utility is and how it differs from the traditional buy and burn models that FTT, OKB, BNB, and the other exchange tokens use.
Yeah, so one of the downsides of, I think, the FTX, OKX, and Huobi tokens models is that you're not paying fees in those tokens. So they may have some sort of a buy and burn, but that's usually a much smaller percentage of their revenues or venues, activities, and economic outputs. And you're not paying fees in the underlying currency itself. So this is something that Binance does for spot. Interestingly enough, they actually don't do this for their perps. So if you pay fees in perps, you're paying solely in USDT, which I think a function of how the futures team at Binance was compensated. And so the powerful thing about CoinFLEX is across the system for any product, if you want to not pay the max sort of quote unquote pleb rate, you have to pay in Flex. So if you're on VIP 1, 2, 3, 4, 5, 6, in order to pay those higher VIP tier fees, and it goes from 8 bips on the perps all the way down to 4 bips on the perps as a taker fee. If you want to pay those lower fees, you have to pay in FlexCoin. So that's the first difference. That's universal across the platform, and it's very, very different from FTT, OKB, HT, and in some ways, even BNB in that sense is the enforcement of it as a fee currency. And then the other thing is we take right now it's just 10% of revenues, 10% of profits, and we burn them. And we're moving to 10% of revenues and 10% of profits and paying them to DAO stakers. And so you can find out about this on coinflex.com/flex 2.0. You can see the white paper. But basically, we are taking FlexCoin, allowing people to stake them into a DAO modeled effectively after the Curve DAO. And the Curve DAO allows you to take CRV, lock it up for any period of 2 weeks, all the way out to 4 years. And then the longer you lock up, the more of the Curve .fi fees you get. And so we're modeling our system off of that. It's going to be launching in the next probably 2 weeks, where the longer you lock up your Flex in the DAO on the blockchain in a smart contract, the more of the CoinFLEX revenue and profits that you get. And so we'll pay 10% of the revenue, 10% of the profits to the DAO stakers. And so it's very different in the sense that it creates an on-chain staking mechanism for FlexCoin, and the whole general public can start to get a look at how long-term committed to FlexCoin people are. So right now, one of the issues with any exchange token is you might say, okay, it's got a $5 billion market cap, it's got a $10 billion market cap, but how much of that free float is panic, paper hands effectively, and how much of it is diamond hands? How much of it is, no matter what, not going to sell? And we don't even know this with stocks. I don't know how much of Tesla is, diamond hand long-term hodlers, and how much of it is like turn on a dime hedge fund guys that might immediately panic sell. So we don't know this with stocks. We don't know this with exchange coins. You'll very soon be able to know this with Flex in a similar way to with Curve and some of the others. You can know definitively, because if someone's locking it up for 4 years, that goes onto the blockchain. The whole world can see, 30% of the supply, 40% of the supply is locked up for an average of 2.5 years. And all of a sudden, the market can get confidence around people's commitments, people's long-term orientations, and then people who are long-term oriented, rather than just getting the appreciation of Flex going up, they can also get this income stream on-chain distributed to them from the governance of the the CoinFLEX platform. And
So,
then tertiary benefits are voting and things like that, but the main thing is you get the staking rewards.
so just to sum up what you were saying there, so when you're holding Flex tokens, you can lock them up for some period, and the longer you lock it up, the higher the percentage of the fees you would get. So instead of you burning Flex tokens like you're doing now, you're going to redistribute the Flex that is received from the people paying fees. Part of it will be redistributed to those that are locking up their Flex tokens in a similar way that Curve works with the VE stuff.
Still doing the burn, burn has not changed. We're adding on this extra
Okay.
incentive to hold FlexCoin. So it's an extra incentive that's getting added, and it's I think it's very powerful because it creates again another form of passive yield native to FlexCoin, and it creates, for those who are looking to be in the FlexCoin trade for a long time, it creates an extra monetization for those folks.
So if I lock up for, but let's say the minimum is 6 months, or I don't know what the plan is there, but if I lock up for 6 months versus 1 year, what is the difference? I get a higher percentage based on what I've locked up?
Yeah, so the way Curve does it and the way we're doing it is, let's say the maximum period is 1 year. We're going to do minimum period 2 weeks, maximum 4 years. But let's say the maximum period is 1 year, and you lock up for half a year. Um, you'll get so you lock up 1,000 flex, you'll get 500 V flex as your balance. And let's say the total amount of flex that's been locked up is turns into 5,000 V flex. You'll get 10% of the cash flows that go to the V flex holders. So if you locked it up for a whole year, instead of getting 500, you'll get 1,000. So you'd be a
And they're not
bigger
tradable.
percentage of the pie. And exactly, and that's the most important thing, is the VFlex is a balance that's tied to your Ethereum and MetaMask account, or Smart BCH account, or whatever, but it's not tradable. So it's a balance, can't be transferred.
Cool. So that, yeah, no, that I think, because in the end with exchange tokens, what people care about is that if you are I'm going to be careful with my words here, but if you're holding the tokens, then you're aligned with the success of the exchange. So as the exchange is generating more volume, generating more fees, then you're almost like a partial owner in the exchange in a way, like, or at least you're aligned with the success of the exchange, such that it's either, many of them are doing buy and burns out there, or just redistributing parts of the profit or the revenue to the holders. But then there's this tension that can be created between the token holders and the equity holders. How have the investors in CoinFLEX sort of dealt with the news that there's more of the value that otherwise would be accruing to them that is going instead to Flex token holders?
Yeah, I think this tension is a really interesting question, and it's definitely a dilemma. The more you incentivize token holders, the less that profits flow back to the equity holders. So it's a dilemma, and that has to be acknowledged. But at the same time, people that buy Flex are effectively buying. I mean, the base utility of Flex is paying fees in the future. So it's like a uh, floating value Starbucks membership card. And the powerful thing about a Starbucks membership card for Starbucks is that the more people buy those gift cards, the more people will in the future spend money at Starbucks. It's the same thing for FlexCoin. So we want as many people to buy these future trading fee credits as possible, because it means they're going to, trade in the future, or they're going to pass it on to someone else who's going to trade in the future. But the other thing is, because they're trading fee credits, we earn them. So anytime someone trades, and the more our volumes go up, we earn more flex every day. And the powerful thing about that is, obviously that means sometimes from time to time we have to sell FlexCoin. So in that sense, we want FlexCoin to go up, because if we earn a bunch of flex at 20 cents, flex goes to $1. We've held on to an appreciating asset. But really, beyond the currency that we have to sell, we want to hold as much flex as possible. So our goal as equity holders, our goal as shareholders and management and a board, is for CoinFLEX to hold as large a percentage of the supply earned over time as possible. So this is very different from, I think, other companies where their goal is to issue some of the treasury or issue some of the initial supply to themselves, and then over time sell out at higher and higher prices. And the earnings of the company might be basically how can we sell the token for, you know, higher and higher prices over time. But fundamentally, like once you've sold all your, let's say your some DeFi project, once you've sold and you're there's a company or a foundation behind it, once you've sold out all those tokens, you know, you're no longer incentivized to care about the token holders. We're earning in the tokens, similar to Binance, and so we're always caring about FlexCoin holders because we are one of the largest FlexCoin holders. We want to be a larger FlexCoin holder. A year from now, I want to hold, um, you know, as high a percentage of the supply as possible, and so and stake it for as long as possible. So it's one of those things where um, there is a there is an incentive, and it has to be made very clear, like where does the equity's interest lie? Is it in just collecting dollar fees and paying as little out to the token holders as possible, or is it in collecting fees in the token and also paying out to the token, but also, you know, being one of the big stakeholders in the governance of the token as well? And that's kind of where we sit on the issue.
Yeah, I think that in this case you've created, and I think it took you guys a while to find the right balance, but a sort of virtuous cycle that is created between the demand and supply sides of Flex, the users of Flex, I'm sure a lot of the equity holders, I mean, like you mentioned yourself, the management and stuff, they're also Flex holders themselves, and so there's a pretty decent alignment of incentives, I think, that has been reached on this. So on the Flex coin point, you've mentioned a couple times now, like there's ETH and then there's Smart BCH, which I know very little about. But what's your philosophy as a sort of as a firm about what chain that the Flex token should be on? Is it a like I know you're a BCH fan. I know a lot of the investors in Flex are BCH guys. Is it like BCH dominance, or is it more like a tether approach where it's like, yeah, we're agnostic to whatever chain? What's the CoinFLEX approach for Flex token?
Yeah, it's a multi-chain approach. So all of our products, like the note tokens, are on BCH and on ETH. Um, we've actually just completed the integration of BSC, so we'll probably launch everything on there as well, FlexCoin and FlexUSD. And we're interested in the other chains. I think Matic has had a lot of commercial success, and there's you know, as a layer two, I think there's others. I mean, Solana is doing a lot of great things. Obviously, it's not EVM compatible, so it's much harder for us to launch FlexUSD on Solana without some extra work. But you know, we would like to launch. I mean, we'd like for FlexUSD to be the dominant stablecoin, and for that to happen, it has to be on every chain. We do so. Smart BCH is a new blockchain. It's kind of like an extra layer one for BCH that's based on the same kind of proof of work hash rate in terms of like your proof of work hash rate on BCH gives you the right to be a validator for Smart BCH. So it's kind of like a proof of work version of Binance Smart Chain, effectively, in that it's much more scalable, much more low fee, and slightly faster than Ethereum, but it's EVM, 100% EVM. And so one of the things for CoinFLEX that's interesting about Smart BCH is obviously we're tied in with the BCH ecosystem, and a lot of people there trust us. But the other thing is we can be the first stablecoin on that blockchain, and I don't think that USDC and Tether are necessarily going to be super early adopters. Like within the first 3 months, we're going to be there day one. So we have an advantage in terms of FlexUSD becoming the dominant stablecoin of that blockchain. And if that blockchain ecosystem takes off, FlexUSD is going to get a bunch of AUM, a bunch of assets, a bunch of market cap. And the benefit of that market cap is that every trader on CoinFLEX will get lower perp rates. So if you care about BCH, look at Smart BCH. I'm guessing 90% or 99% of this audience doesn't. If you care about CoinFLEX, and if you care about trading and having low perp funding rates, then FlexUSD and Smart BCH are going to help you on CoinFLEX because they'll lower the perp funding that you pay.
Yeah, I mean, it might surprise you, but we actually even have a BSV advocate here. He absolutely loves BSV and has all kinds of theories about why that's the real Bitcoin. So we have a pretty diverse group here. Yeah.
Oh, cool. That's great.
But yeah, and actually you mentioned Solana. A lot of people here are fans of Solana, including myself. So I think it would be interesting. And I think that in the end, part of the success of Tether, and that's why I brought them up as sort of one model, is that they have been chain agnostic. And I think exchanges in general succeed when they don't play the political game and the tribal game between
correct.
assets.
Absolutely.
It's just stay neutral, just provide the products people want, and keep it simple. So all right, I think that covers everything in terms of the products and the coin. I didn't really have anything else on there. I have a few other like ancillary sort of side questions if you still have time. I know we've been going at it for over 2 hours, but I love talking to you. I love chatting, talking shop with you. So I have a few other questions if you have time to stick around a bit.
Absolutely, yeah.
Sweet.
Let's do it.
So
love talking to you too.
I don't know if you saw the news today. I'm curious what your take is on this, but FTX recently implemented a 20x leverage max cap on their exchange. I don't know if you got a chance already to sort of see the reasoning behind it. Mostly it came down to SBF was saying that exchanges, most traders are not using more than 20x anyway. So in terms of where the industry is going and the regulatory pressure around high leverage, that they just decided as a business max leverage 20x. What is the CoinFLEX position on leverage and whether it should be controlled at some level like that?
Yeah, my first thought was this is gonna be this is gonna make it difficult for them to capture some of the incremental flows that right now go to Bybit and Binance specifically. I think, maybe FTX's flows right now are not very high leveraged or are not, they're not that type of flows. But a lot of the bigger exchanges by volume do have a lot of those types of flows. So it I think they're taking a stance, maybe for their customers or their investors or the regulatory conversations they're in. I don't think it's very imaginable that any at least U.S. regulator wouldn't just want derivatives to be shut down, because the U.S. regulators just hate derivatives that are anywhere beyond 2x, as we've seen with CME. CME is kind of, I know CME loves leverage and they would love to do higher leverage for crypto. They can't because of regulators, CFTC. So I don't imagine this was really regulatorily driven. Maybe it was something that will help out their institutional customers, but I think it is something that is slightly at the detriment of retail. I'm kind of curious as to how they do it from a maintenance margin perspective, because maybe they keep that really low and loose, and just they're only changing the initial. If it's like that, then maybe it won't have a big effect. But I think it makes it harder of a sell if you're someone that's at Bybit and looking to switch. We're interested in keeping 100x. I think 100x is also something that is really a way to test with small size or do a limited liability punt. Arthur Hayes has often talked about how 100x perps are very similar in a way to an options contract. Because I see this as well with the AMM. You're selling you use the term selling gamma. You're really selling perpetual options, and the other side of that trade is someone who's buying perpetual options, and perps are effectively an options contract. You can only lose what you put in. So I think they're making the compellingness of that option or that perp less, but who knows? Maybe their customers really prefer it, or maybe it's affecting the margining system in some negative way. We don't see that kind of thing affecting our margining system, so we're probably not likely to go that direction.
Yeah, I mean, and I'm not sure if you've seen that paper by I forget his name from Paradigm. I think it's Dave White and Sam from FTX, the everlasting options paper, which
I have, yeah.
Yeah, and I mean, I guess that's sort of a bit different, but I think you're right in saying what Arthur was referring to, where like if you put a small amount of capital in at 100x, sure, statistically, you're very, very likely to get liquidated. I mean, let's be honest, that's the way that if you just look at the time series of the price of any crypto assets, all you need is, let's say that 100x, you put down 1% maintenance margin, and all it takes is a 0.5% move in the price, and you're completely liquidated, or even less, right? So you're once you hit your maintenance margin, you're out, and your position is wrecked. And statistically, you get the white noise and this random walk, which is makes it very, very high probability, just based purely on a statistical sense, very high probability that you get simply liquidated. So I do think that I mean, I don't like the idea of necessarily being like paternal with people in crypto and saying like, oh, it's for your own protection that we are doing this. I don't think that's an effective way to build products in our industry. But I do think that there's merit to the fact that a lot of people just get destroyed with really high leverage. And back in the day, I'm not sure if you remember, Sam, the CTO of BitMEX, he used to actually refer to this as selling dynamite to children. This was before BitMEX was 100x, right? But back in way, I think you probably remember this.
I remember they viewed themselves as the Goldman Sachs of crypto, and they criticized OKCoin, as it was called back in the day, and Huobi for maybe it was, I think, back then it was just OKCoin futures, and obviously the previous ICBit and some of the other derivatives exchanges for offering these crazy high levels of leverage. I think, what was it? BitMEX capped themselves out at what, 3 or 5x? It was something really small.
It was about like 6x at the time. This was late 2014, early 2015. And they struggled to get any kind of traction at that leverage. And enough people in the community were sort of badgering them and saying like, we need way more leverage, like give us more leverage. But there was a solid like 6 to 9 months in the beginning there with them, where they were really trying to make their case and saying, no, it's irresponsible. So you're giving just the quote was actually selling dynamite to children if you're giving people too high of a leverage.
Amazing.
And now look what happened with them, right? So I mean that's also, I think, an important lesson that you gotta, and I think you guys have been good at this, to your credit, at the CoinFLEX, that you gotta move with the market. It's fine to try something, and if the market reacts in a certain way, like learn from it, pivot, grow, and build new stuff to meet the demands of the market. And I think BitMEX did that, and I think you guys at CoinFLEX are doing that. That's the only way to survive in this market, right?
Yeah, absolutely. And I mean, we are offering leverage on the AMM, but we're limiting it massively. So it's one of those things where I think you have to educate users. You have to provide kind of interface guides and different things that do educate users. And the other thing is, like, there are some exchanges that focus very heavily on these kind of degen punters, and at the end of the day, a lot of their customers burn out. And what we're trying to focus on, is getting retail and institutional and passive and high net worth investors into passive capital products where, they might not have a really high conviction bet on the market right now that they want to put on a leveraged derivative position. But if they start using the AMM, they're obviously going to be, interacting with small amounts of leverage, but they're probably going to be comfortable putting way more of their personal capital into that type of product than someone would punt on a highly leveraged bet. So I do think, like, there's ways to do leverage, including high leverage, that's responsible, sustainable, and can last a really long time. So yeah, I mean, you do have to move with the market at the end of the day.
Yeah, and I actually just looked at my AMM. My APR is now showing as 310%. So there you go. Just
that's awesome.
Keeping people
that's
updated.
Wonderful.
Yeah. Another thing, which is, you mentioned you guys were in Hong Kong. At least I assume your offices and most of the team is probably working out of Hong Kong. And I know FTX is also based in Hong Kong. BitMEX is also based in Hong Kong. Recently, and I know this is a sensitive topic, so if there's something, feel free to not answer whatever you don't want to answer. But recently with this national security law that's been put in place, and the mainland in China getting sort of a bit more strict, and some of the higher society people in Hong Kong kind of sucking up to the mainland. Do you think that Hong Kong is still the right place for firms in crypto to be based, and that they're sort of it's still going to be a free enough place, not just in terms of the free flow of capital, but also the kind of freedom that crypto often brings to people, which some states can see as threatening? Do you think that this can somehow end up, we just saw China banning mining. Do you think that this anti-crypto views that the mainland has could be pouring over into Hong Kong, and whether it could be impacting businesses like yourselves and other competitors in crypto?
Well, I say that I'm in Hong Kong. I'm personally in Hong Kong. Oh, can you still hear me?
Yep.
Okay, cool. I'm personally in Hong Kong. Obviously, my co-founder Sudu is in Hong Kong. Our company is incorporated in Seychelles, and we actually don't have much more than 1/3 of our team in any one place. So we're pretty globally distributed, and so just there is that. And if we had to migrate somewhere, we could do that pretty easily because we're globally distributed. But I think a lot of the I don't want to comment too much about what's changed, but most of it has been related to protesting against the government and things around security around protesting against the government. None of it has to do with crypto. So I think Hong Kong is still a pretty safe place to be a crypto founder. Um, there's a lot of other countries that have kind of laws around don't talk smack about the government, or don't do this or don't do that in terms of speech and other things. And so I'm not like, oh yeah, we should probably move somewhere. I don't hold those views. I do generally think that Asia is one of the best places to be in terms of crypto. Hong Kong is a very nice place to live. uh, you can kind of bridge the West and the East. And yeah, I mean, I like Hong Kong a lot, but we're as a business not at all married to it, and the majority of our employees don't live here and don't work here. So.
And yeah, I mean that's fair, and I understand from friends in Hong Kong that aren't from the West that uh, it kind of reminds me of the BLM protests. Like if you talk to people locally in a lot of the cities that were impacted, they didn't like these were not nice protests. They were extremely disruptive to the people's everyday lives. A lot of stores got smashed up, businesses looted and destroyed. And I have a feeling that from when I talk to locals in Hong Kong, especially non-Western ones, that they're kind of like, yeah, we don't like these protesters. They're actually really annoying, and they cause a lot of disruption in terms of the just the everyday stability of society. And I mean, obviously, there's a lot of people sympathizing with protesters, and there's a reason why people are protesting in both of the examples that I gave. But at the same time, it's not in the West. I think it's often quite one-sided when people look at this and it's like, of course, you should let people protest and do this kind of stuff, but it's also very disruptive and very can be chaotic for people in their daily lives. Anyway, yeah, I know it's I won't get into any more on that. I was just curious in terms of the business environment, especially that. Yeah, I know that it's yeah, things are shifting a little bit there, but obviously a lot of firms are able to still stay in Hong Kong, and it's been years since I last have been there. I'll be going back though.
Can't wait for you to visit, man. It's gonna be awesome.
Yeah. It's been, yeah. Obviously, with the COVID rules, it's a bit fucked up still, but yeah, I haven't been there in a few years now, maybe 2.5 years, but I should try and get back out there. So yeah, last thing I wanted to sort of bring up, just as a side thing, is it has come up a bit in our conversations. Bitcoin Cash. The BCH is no longer a top 10 coin. It's kind of slipped out since I think maybe a couple of years ago or so, when we last were chatting about BCH and the potential that it had. It was still like a top 5 coin. What do you think is the future of BCH? You have mentioned smart BCH with a chain, but I mean, obviously, it is the market has spoken in some sense. It has slipped from the top 10 slots. Do you think it's going to be getting back in the top 10? Do you think there's too much competition coming out there from all kinds of other chains? What's your what do you think is coming in terms of BCH in the future?
I mean, I'll say as CoinFLEX, we're a neutral exchange. We want all our markets to grow. But I'm also, a long-term crypto believer and hodler, and have been, holding crypto for 10 years at this point. And so I do have personal views and personal holdings as well. So, I mean, I think the reason Bitcoin Cash slipped out of the top 5 spot, and kind of the reason that BCH BTC ratio has dropped so much, is really because most of the narrative of there's been 2 driving narratives in this bull market. One of them has been sort of BTC as a store of value, BTC as an institutionalized investment. All of a sudden, all these institutional products coming out into the market. And then the second one has been around DeFi. And so the first one has driven up Bitcoin, and the second one has driven up all the coins related to DeFi, obviously Ethereum, and also potential quote unquote ETH killers, right? The thing that hasn't happened is no one has done lots of transactions on the BTC blockchain. And so there in 2017, we had this mass period where there's lots of Bitcoin transactions and the fees went very high. This cycle, we haven't seen that as much. I think a lot of the people, a lot of the investment managers and institutional investors that are putting money into Bitcoin basically think of it as a digital gold. And when I think digital, I think something that is cheap to send, cheap to use, and basically instant. And so they think of that as Bitcoin. I think one of the things that's powerful in BCH is that it is actually that. And one of the things that's problematic in BTC is if these investment managers and these institutions actually tried using BTC, they would find you can't, buy a pizza with it because it's $10 to transact on the blockchain. You can't do all sorts of things with it because as a business user, you might end up paying $100,000 to do a transaction fee if you have a lot of UTXOs, as I did in 2017. So I do think there's no way to get part of that back. Like getting these institutions to transact on the chain and encounter these problems, it's not going to happen. What is it might happen at some point when Bitcoin and crypto is getting more real world usage, like the El Salvador stuff. But in the short term, it's not going to happen. What I do think is going to happen about BCH is everything related to smart BCH is going to turbocharge a new type of BCH user that is actually very similar to an Ethereum user. Someone that cares about DeFi but isn't married to one blockchain, is relatively apolitical, not tied to one blockchain. They just care about cheap fees and decentralization. With BSC, they got a taste of cheap fees, but then they became kind of in tune with the realities of centralization, with some of the problems, including just like server downtime and overload relating to BSC. So I think with smart BCH, you get both cheap fees and high scalability and decentralization, and you also get this added benefit in that they've actually made a number of technological advancements, including basically removing or almost eliminating minor extractable value. So they have a transaction randomizing effect within a block that effectively eliminates the possibility to extract value from DeFi users by being a miner yourself or being a node validator yourself. And that's been a problem that's just plagued like BCA, ETH, and other. Yeah. So I think I'm very long-term bullish on BCH. I think the short-term catalyst is going to be smart BCH. The catalyst beyond that will be a lot of the people that bought Bitcoin sort of realizing that it doesn't do what it says on the tin, so to speak. But I think the biggest short-term catalyst that gets people to wake up to Bitcoin Cash as an asset is just going to be smart BCH, because it's just a better version of a DeFi ecosystem than Ethereum.
So the smart BCH, like what kind of block times are we talking about with smart BCH? I haven't read enough about it to know, but how short are the block times?
Yeah, it's so 6-second block times.
Yeah, I don't know. A lot of us here we think Solana is basically you get it down to 400 milliseconds, and the MEV is like negligible. It's like impossible to really extract anything from users in Solana. So yeah, I think there's so many different, and it becomes sort of another ETH killer, smart BCH, right?
Here's the thing that's powerful about Solana. Anytime you're beyond maybe 500 milliseconds or 1 second or something like that, you are faster than the eye can see. So, you click something and it's responsive. It feels like a website. It feels like an app, right? Anytime you have to wait for 6 seconds, even though it's only 6 seconds, it's still slower than some other type of web operation. So that's the cool thing about Solana. The downside is, in order to become a validator, you do have to do full KYC. You have to get approved, I think, by the Solana Foundation. And that means that if a regulatory body wanted to go after this type of activity and say, okay, we're going to clamp down, they could. Now, that's a tail risk that might never materialize. So Solana might be more centralized, but maybe it doesn't matter. And so that's the bull case for Solana is they're short a tail risk that never materializes, and it's a great DeFi ecosystem because it creates an experience that is web 2.0 or mobile app like, but for web 3.0 decentralized blockchain apps. The bull case for smart BCH is that it's a little bit slower, but it's fully decentralized.
So one thing I will correct you on gently is that Solana validators do not need to KYC. It's a permissionless network. There was a special award that the Solana Foundation was giving to bootstrap validators, and in order to actually qualify for that award, you would need to KYC and register and everything like that. But it is permissionless. Anybody can spin up a validator and join the network. So it doesn't require KYC.
Fair enough. But I stand corrected. I'm sorry for the accusation.
No, it's not.
I'm excited. Just to be clear, I'm very excited about Solana as well. I do think there's some big advantages to what we're building, and even separate to like just as an EVM perspective, I think there's advantages to having the same genesis as BTC and the same block size and kind of not block size, but coin limits and total supply and initial supply and stuff like that. But yeah, no, I mean Solana may do very well. I just think that at the end of the day, you can't be completely centralized. You can't be completely decentralized when you're 400 milliseconds, just because of the nature of server topologies.
Yeah, that's what I was going to say. Even if you ignore the KYC point, the centralization issue is still there with Solana. I think at the moment all it takes is 12 or 11 validators. I haven't checked the latest to halt the network, because you only need a third of the validators. So that's, of course, it's more centralized, and the hardware requirements could get more and more onerous. So you mentioned BCH. So you about the same coin limit. Do you think that BCH will always maintain the 21 million? Is that something that the community is pretty firm on? Because there are certain other things where they've been sort of loosening up on things. Is the coin limit something that you think will ever be breached?
It's sacred.
But then
it's never going to be breached.
What about, so do you think then that similar to what Bitcoin proponent says that you don't need to have a miner subsidy in the long run because network usage will simply be sufficient enough to have it so that the fees going to miners from transactions that go into the blocks will cover whatever security is needed on chain.
Yeah, I hold that view. I think you know, Satoshi kind of invented the system with that original view, and I'm not like, look, I don't think that I don't think like Satoshi was God. I think he made mistakes. I think it's a problem to put him as a deity. But I do also think you know, this was one where he was probably right. You know, transaction fees. If Bitcoin Cash gets to the level of a Visa or a PayPal or even less, I mean, ETH. The easiest example is ETH fees at one point surpassed. No, they didn't. They surpassed Bitcoin fees. They got pretty close to surpassing the Bitcoin inflation. I don't know whether they exactly surpassed it, so I won't make that claim, but they got very close to surpassing the actual Bitcoin inflation. And so at one point, I think all in, ETH miners were making more than Bitcoin miners, even though the Bitcoin market cap was way higher. And that's just an example. You know, when you have a vibrant blockchain that people are doing lots of real productive things on, you know, ETH is like, in terms of usage, Ethereum is what BCH wants to be. I mean, BCH wants to be the usage dominated blockchain. That's Ethereum. So I do think Ethereum has done a really good job in demonstrating, maybe not payments. Bitcoin Cash is very focused on payments, but with Smart BCH, we catch up on the focus on smart contracts, DeFi, and everything decentralized on-chain contracts. And Ethereum has done a good job at that, and that has demonstrated that you don't need inflation. You can have real-world usage and real-world fees as the subsidy.
Yeah, fair enough. All right, well, let's see if anybody has anyone who's been listening. I know we've basically touched on everything to do with CoinFLEX products and a lot of other topics. I know there's people in YouTube as well who might have any questions. I'm looking now, I don't see any. Yeah, okay, we got someone saying that when the Solana listing SOL, and you say it's coming soon.
Yep, we're definitely going to list Solana.
Is it? Have you guys had troubles like hooking up the nodes in order to receive the deposits? Is that a pain, or what's the blocker?
Yeah, I mean, again, BSC integration was really easy. You know, it's I think the lack of EVM, and one of the things, as someone who is not like a big Solana investor or anything, but just as someone who follows blockchains, one of the things I'm excited about with Solana is, you know, I think there is going to be an EVM compatibility framework of some sorts, and I think that's just going to turbocharge activity massively. Like whether or not Ethereum long term wins the DeFi or the smart contract, use case, EVM, in my view, has won. At least it's won significantly further ahead kind of grounds than any other technological platform or technological framework. Like if you are a smart contract developer, EVM is the way to go. And the network effect, not just of Ethereum, but now of multiple other blockchains that use EVM that you get, is enormous.
I think that is sort of a fair point, but I think that there's limitations to EVM as well, and I think a lot of the Solana developers that I talk to who are doing everything on Rust and doing their own thing, they're incentivized to get involved because they can do things that they literally cannot do on Ethereum or on EVM. So they're sort of
sure, absolutely.
Like this is what I think is so bullish about Solana, and or more bearish for Ethereum. But like there's nothing that you can do on ETH that you can't do on Solana. There are many things that you can do on Solana and other chains that you simply cannot do on ETH. And the other thing about whether or not ETH is going to be like the smart contract platform into the future, I don't think so. I think 10 years from now, this is going to be a very different conversation. I'm sure we'll be still in touch in 10 years and we can follow up on this in 2031 and see what has happened. But my opinion is that it will slowly sort of dwindle in its relevance. I think that the fragmentation of liquidity on ETH that we already see on, there's layer one, and then you've got Optimism, you've got Arbitrum, you've got Matic and XDAI, and there's different of the popular dApps that are on different side chains and L2s. That fragmentation creates a bad user experience in the end, and that's, I think, going to be damaging down the line, especially with ETH2 coming along, and that throws a whole nother wrench into the equation.
Honestly, I really couldn't agree with you more on this one. I'm very skeptical of proof of stake. Generally, I think it causes problems around centralization of the people with the most balances end up having the most control. So you have you'll have Binance and other exchanges having a lot of control, which as an exchange I would not want to have. When we are as big as Binance, I would not want to have political control over a coin like Ethereum. But I think also the focus, if you think about what Ethereum people are excited about in terms of the devs and the biggest champions of the community, there is a sense that they're maybe more excited about EIP 1559 than actually about solving fee pressure problems on the Ethereum network themselves. And they like seeing things like Polygon, Matic, all these other layer twos take off rather than fixing those problems on one chain. And the problem that occurs is exactly what you said: fragmentation of liquidity. Matic, an application running on Matic is just simply not fungible and cannot access the same asset base, the same liquidity base, the same trading base as the same app on ETH layer one. And at the end of the day, an app builder can just say, oh, well, why do this, stuff that's super fragmented when I can just build on Solana or Smart BCH or some other chain that is actually trying to host all of the activity in one place. So yeah, I mean, I think if anything is going to actually be an Ethereum killer, or any concept is going to be an Ethereum killer, it's going to be the fact that there wasn't as much of a focus on solving problems on the main blockchain itself, and a lot of this fragmentation happened.
Yeah, that's pretty ironic, right? I agree 100% that the real ETH killer in the end is going to be ETH itself. It's going to be an ETH suicide, right? Like, that's the irony of it.
Well, because I think about network effects all day long, right? Like, as an exchange, the more liquidity you have, the more liquidity you have. And RAMM is like a typical example of that. And a lot of these things are, the more FlexUSD exists, the more people feel comfortable minting FlexUSD. So like, I think about network effects all day long. The biggest problem that ETH has is they have a network effect working for them, in that if I'm listing a new token, I'll do it on Uniswap, which is ultimately on Ethereum. Et cetera, et cetera, et cetera, Compound, all these things, right? So they have a network effect working for them, but that same network effect works against them, where when the more people use their network, the higher the fees go, and then the higher the fees go, the less people want to use their network, and the more people are incentivized to switch. And I think actually Bitcoin is really weird in that because of this sort of institutional narrative, it has no impact on all of this. So ETH, people investing in ETH, people who are like, I'm going to buy 40% of my portfolio, I'm going to put into ETH. They actually do think about this stuff. They think about, oh, wow, ETH fees are really high. I should think about how the end user is going to be affected by these fees, and I'm going to think about maybe reallocating some of my assets into Solana or into Polkadot or into something else because of this. People that buy Bitcoin, they don't think about this. They don't think about like the end user as much, because they're just thinking about this as this kind of like asset. People sometimes joke about it. Bitcoin is like a pet rock, but effectively it doesn't need to do anything. I think if that ever changed, like BTC dominance would change in a way that I guess a lot of people in here are holding non-BTC coins, and I think it would make them really rich. But I think also like one of the problems that Ethereum has is that the people investing in it ultimately are pretty smart people who do think about these network effects, and the people that are maybe building it or contributing to it are probably at least from what we see in terms of practical effects, they're kind of slightly more focused on 1559, proof of stake, and some of these things that don't necessarily reduce on-chain fees in terms of like level 2s and stuff.
Yeah, that's why I would actually say that I don't know if you've seen some of these .eth characters on Twitter. I think a lot of them actually don't care about the impact on the user in the end. Like that was one of the things that really struck me, particularly last year during DeFi summer, was that I remember very vividly, and you talk a lot about this, like you're paying six-figure fee on BTC in early 2018 or late 2017. I remember that very vividly, not your specific incident, but that environment of like, holy shit, did I really just spend, $200 just to move some coin around? And we really felt that on Ethereum the first time last year during DeFi summer. And a lot of people back in 2017, 2018 in the Bitcoin community, they sort of were like, I saw it as cope, when people were like, oh,
massive
it's so valuable that I'm willing to spend hundreds and hundreds of dollars just to move it around. And then guess what? When this happened on Ethereum, and a lot of Ethereum people mocked Bitcoiners for celebrating high fees, like it was kind of ridiculous to be doing that. But then they did the same exact thing last year in DeFi summer. It's like, oh yeah, it's worth it to spend thousands of dollars for fees on Ethereum, and that's great. We should celebrate that. And then it kind of hit me like, well, what are these guys doing? Like, are they not understanding what a bad user experience that this is? And that's what got me really into Solana and alternative chains. Was like these .eth people are totally crazy. Like they don't get what people are feeling when they're spending those kinds of fees.
It's not that they're crazy, it's that they're short-sighted. And what part of I think there's two things that drive that apathetic attitude towards the high fee payers. One is some of the .eth people are rich, so they've made a shit ton of money. I mean, anyone, I've been in crypto. Everyone that's been in crypto a long time has done well. So if you've done well, you think, oh yeah, I can pay $50 in fees, no worries. It's less than my lunch, right? But that's like way more than anyone else's lunch, and that's way more than anyone else can afford to spend. And so some of it is a disconnection because of the wealth effect, and then another part of it is actually more interesting, which is if you're doing on-chain arbitrage opportunities, if you're doing on-chain activity that requires capital, so you're arbing two markets, you're doing a yield farming activity where you're borrowing from somewhere that will incentivize you to borrow, and you're lending to somewhere that incentivizes you to lend, or you're staking, or you're LPing. You actually want high fees because these dApps will reward you in their native token, their governance token, and they'll reward you based on the amount of activity you do. And so if you're a multimillionaire or a billionaire and you're transacting on the ETH network, you really want it to be more expensive so that you can kind of close the gate out on the plebs and make sure that they don't yield farm alongside of you. Because they're diluting your returns. If you've got some sweet yield farm or some sweet ARB, you want as few people able to take that as possible. And so I think the interest. So this is where the mindset, and it is a mindset and a philosophy and a design decision and a product decision of Solana, Bitcoin Cash mainnet today, and also Smart BCH is a very different one of, rather than, okay, let's just be this asset that has these characteristics. It's a product and end user focused mindset. And the reflection of that is cheap fees. And I think like you can see there's a cost, right? Like at the end of the day, the upside, if you're an Ethereum holder, of the high fees is that everyone's spending an ETH every day, buying ETH to spend it. And that pushes up the price of ETH. So there is a downside to the Solana and BCH approach, but there's a long-term upside. It's a trade-off of sacrificing some short-term in exchange for massive long-term upside, because you win over the next gen of ecosystem users that are not rich. They're not loaded early OG adopters that can just afford to spend $50 to move coins around.
Yeah, one way I've heard it described is that it was, and it again started in the DeFi summer last year on Ethereum, is that it was like the gentrification of the blockchain. You would have you would have all these DeFi bros that are just like clogging the chain themselves, doing all these goofy yield farming things, and I mean goofy because they were creating like food tokens and obscure stupid shit like that, and anyone that was coming in and heard about this DeFi thing, this Ethereum thing, they would try it out. They would maybe and when you try something out, usually maybe it's like $20, $10 you want to put in, and all of it would go towards an initial Ethereum transaction that they're just trying to move ETH from one point to the next. And I've seen it with my own eyes, like bringing people into the space. And I've been doing this like you have since forever, like almost a decade now. And I've introduced people to Bitcoin. I've introduced people to Ethereum. I've introduced people to Solana. And, just like back in early 2018, late 2017, people would buy $100 of Bitcoin, and they would, so a lot of the places where you would buy Bitcoin, they would, you would give them address and they would send the transaction to you. And so people would spend $100, they would get some Bitcoin, and then in order to get it to their wallet, they would spend like $40 for the transaction to get it to their own wallet. And then, the net fee that they're spending then is like 40-50%. That's terrible UX. Similarly, with ETH, people would throw in like, 20, 30, $40. They would move ETH around from, even just, to approve the interaction with Uniswap, and then sending the actual transaction and all that stuff. Before you know it, 30, 40, 50% of what they put into it is gone just from fees.
It's gone.
That's gone. Bad UX. It's just bad UX. I've seen it with my own eyes. People, the disbelief in people, like, what the fuck? Did I really just spend over half of what I put in, moving it around on the chain? That's just bad. So.
Yeah, $50 is a really low fee if you're spending $1 million. If you're spending $100, it's 50%. So yeah, I mean, it's terrible UX, and those people are never coming back. And in a way, they might never come back to crypto, but they're definitely never coming back to that blockchain. So I think, it's important that these alternatives succeed, because at least from a crypto user base perspective, like, again, I think there's a lot of people that invest in BTC just because it has a ticker and it's accessible on kind of institutional platforms that they are familiar with. And so they might never transact on chain, and they might just buy BTC and that's it. But for the people that are actually using crypto, these fees matter enormously. So chains that I think have this mentality and focus and philosophy around low fees and high scalability are going to do way better in the long run than others.
Yeah, and I think in the end, it's the people who win are the ones that are sort of open-minded enough to at least play around with different technology in the space, and to be open to having these kinds of discussions of pros and cons, and especially people that have the end goal of crypto adoption and trying to bring crypto to everybody. And in order for that to be accessible, there's certain technical and economic realities that have to be in place. And I would say, just to defend Bitcoin a bit, that there are some cool things with Lightning, especially RGB. That there's going to be, I think, some potential for smart contracts on layer 2 on Bitcoin. And I wouldn't count it out in terms of having utility. It doesn't necessarily just because a lot of people are calling it digital gold, and they look at it as there's a strong macro narrative behind it, the Michael Saylors of the world. There is still a lot of people that are doing great work on layer 2 on Bitcoin. And so I think those guys, hopefully will have some, there's already some use on Lightning Network, not a lot, but I think there will, when you have adoption by El Salvador and you have these other things going on, they need to use Lightning when it comes down to it, if they're insisting on using Bitcoin. Like I would say Jack from Twitter, if he's saying that Bitcoin is in the future of Twitter, like very closely, then I can't see how that would exist without Lightning being involved, for example.
I think Lightning is one of those products where there's some problematic capital efficiency issues around needing to fund the entire other side of what you're going to receive. And those capital efficiency issues might be solvable, but some people say like, oh yeah, Lightning UX, is just something that's going to be fixed in the future. It's also possible that it might be unfixable, at least in the current structure of Lightning, due to the architecture around capital efficiency. And I don't want to like have a big debate about that because who knows. But I think with crypto products, one of the powerful things is the ones that are very good, the ones that have lots of capital efficiency, have lots of composability, have lots of like easy user friendliness, they do tend to take off. So if a product hasn't taken off for a while, and like hey, at the end of the day, we've known this at CoinFLEX. Like we invented quarterly deliverable futures, and we got a bunch of feedback saying, hey, we love the fact that they're deliverable, but you've got a few problems here. One, they're quarterly. Everyone wants to trade perps. And so we took that feedback and we changed the product into a deliverable perp instead. And so I think one of the things you find is like in crypto, if something doesn't take off, it's often for a reason. And if something does take off, it's also often for a reason. And so Lightning's been around for a while. Maybe it takes off in the future. I'm kind of struggling to see what the catalyst is. But yes, there are other Bitcoin smart contract things that are kind of being attempted right now. And we'll see how that goes.
Yeah, I think that's a fair point about like if it's been around and hasn't taken off, then maybe it just never will take off. But I remember Uniswap early on, nobody really took it seriously, and it suddenly sort of just boom took off.
Oh, totally. I mean, BitMEX was another example of that. I remember for years I would check on BitMEX volumes, and they were sub $100,000 per day. That's dollars, as in 6 figures. And this was a time when there were futures markets active elsewhere. It's not like futures weren't a thing. OKCoin had futures, and I think there was another exchange called like 796 Exchange or something. And so there were futures in crypto. BitMEX was tiny, and if you just looked at that venue, you'd think, oh, this is basically dead. There's no liquidity. So yeah, no, things do sometimes take a while. And yeah, maybe El Salvador is the catalyst for Lightning, or maybe it's something else. I just I sort of struggle to see it with the capital efficiency problems, but let's see.
Yeah. All right, man. Cool. Well, it's been almost 3 hours now chatting. I know it's getting late there where you are. So, are there any final points you want to make about things coming up on CoinFLEX? Upcoming, I know you mentioned Solana listing sometime soon. Anything else that you want listeners and the guys here to have a takeaway in terms of CoinFLEX? I think we've gone to a lot of different topics over the past 3 hours. So anybody that thinks they missed something, just look on the YouTube video. But any sort of like final parting shots on your side, Mark?
I'll just say, we'd love it if you tried our AMM. Let us know what you think. Try some of the other products. You can message me on Telegram at Mark David Lamb. You can check out our CoinFLEX Telegram, CoinFLEX_announcements, and just CoinFLEX_EN. And yeah, like thanks so much for having me on. Swap Man, it's always awesome chatting with you, and thanks for running such a great podcast here. Great show.
Yeah, it's always great chatting with you, man. And the community here loves to hear from exchange owners that are cool enough to come on the ground, hang out with us for a couple hours, so a few hours. And it shows that, you're an OG. You've been in this game forever, and you're here to stay, and you're passionate enough to stay up and chat with us and go through the product and have a little side chat as well. I think everyone appreciates that. And yeah, anyone out there, you just go to coinflex.com and you can spin up an account. Like Mark said, even with your Ethereum wallet on MetaMask, and just immediately get started trading, throw some coins on there. spot, margin, futures, AMM. There's plenty of things to play around with on there, so give it a try. And yeah, man, thanks a lot, Mark. It's great chatting with you, and hope to have you on again in a couple of years when you guys have overtaken Binance. It sounds like that's the goal. So we'll have you back on to celebrate when that happens.
Sounds good. Thanks so much, man. See ya.
All right, sweet. Have a good night. Cheers.
Good night.